Hi, if everybody could grab a seat, preferably one that somebody's not already sitting in. Wow, what a great room. There still are some wonderful seats right up front, so please come in, don't be shy. Come on in. There's overflow on the sides, but we've got some really wonderful seats up front. So on behalf of the Aspen Institute and Prudential Financial, good afternoon. Welcome. This is an extraordinary room. Thank you so much for joining us today. My name is Ida Rademacher, and I'm a vice president at the Aspen Institute, and I'm also co-chairing the new Partnership on an Inclusive Economy that the Aspen Institute is unrolling, which you'll hear much more about later from our CEO. I'll be your guide for the day. And like everybody in this room, and I know because we curated this list and are just in awe of who has come together today, but like everybody here, I've spent a lot of my career working on policy and market innovation that drives the economy, and in particular financial markets, toward greater opportunity, equity, and inclusion. And like many of you in the room today, I'm at an inflection point. In one way or another, we are asking ourselves a version of a question that I heard just in a room a few minutes ago from Kathy Clark, who will be a speaker later today. And apparently she heard it from somebody else in the room. So I know that this is a question we're all asking. How do we harness this sense of urgency so it becomes a vehicle for authentic change? As your guide today, I want to posit 3 challenges to you as we get started. Meet someone new. Authentic change is going to require new kinds of collaboration and new kinds of partners, and I promise you, somebody you haven't worked with yet but will is in the room today. Number 2, be honest. Authentic change requires that we look at ourselves and our field critically. We certainly can celebrate success, but we have to push ourselves further, and that takes a critical lens. And number 3, be brave. Authentic change requires a field of leaders with even more ambition and being unafraid of being a first mover to shift a paradigm. And speaking of being honest and brave and new, it's my pleasure now to turn over to Dan Porterfield, who is Aspen's CEO and my boss. And Dan, as for many of you who haven't had the pleasure of meeting him, Dan joined the Institute as our CEO in June of 2018. And from his earliest days, he has demonstrated deep, passionate commitment to inclusivity, diversity, and next-generation leadership. He challenges, inspires us every day at the Institute, and I know he will do the same for all of us in the room. So, Dan, it's my pleasure.
Thank you, Ida, for all of your leadership, and thank you all for being here today for this summit that we're presenting together with Prudential, our co-hosts. And let's begin by thanking all of those who helped to prepare this room, who served our refreshments, who are making it possible for us to enjoy this space together here. Thank you all for everything you've done. I know I speak for all of us at the Aspen Institute when I thank Prudential and CEO Charlie Lowry, who I'll have the pleasure of introducing in a couple moments, for all you do throughout your organization to promote financial inclusion and to show that the private sector can play a catalytic role in creating an inclusive economy in which all people and communities can thrive. Thank you so much, Charlie, for everything you do. Thank you. Prudential is the Aspen Institute's longtime and deeply valued strategic partner on all kinds of efforts to drive systemic change in the ways that our global labor and financial markets work for young people, for the disadvantaged, for places, for the financially vulnerable. Our work together has advanced both policy and market solutions to a lot of big challenges that are facing families and communities. I mean, for example, and I really want to thank Charlie, you and your whole team, Latha, everyone. Thank you for supporting our Reconnecting Work and Wealth initiative, which is led by our colleagues Maureen Conway and Ida Rademacher. And thank you for the $5 million investment in our Global Opportunity Youth Initiative, led by Jamie McAuliffe and Steve Patrick, which is a part of our effort and your effort to connect, support, and invest young people, rising generations, in the future of our planet and the future of their communities. And it's just so exciting to see work being done in India and South Africa, around the globe because of your investment. Thank you so much. All of this is really, though, all what we're doing today, it's about aligning our ideas and our actions to promote financial security for everyone. We're here today to write the next chapters in this work, and rising economic inequality remains absolutely one of the defining challenges of our time. It's acute, it's ubiquitous, it's global, and it's a moral challenge. Its urgency can sometimes be obscured by the economic headlines, where any given indicators might say, well, this is a time of widespread prosperity. It's the best of times. But in reality, we all know that our social cohesion in many different communities is really fraying because of both widening inequalities that are real, are happening in the moment, and then also with that, just an escalating rate of economic change and volatility that potentially threatens economic security for all. And those two factors are critical, and they're hard to talk about, they're hard to get people focused on sometimes if they perceive that things are moving in the right direction. And that's why the Aspen Institute, in partnership with partners like Prudential and many in this room, has decided to pull together our people, our programs, our networks, our convening power in sort of pursuit of solutions that drive change towards a more free, just, and equitable society. We have many great programs. We're really working to pull it together as an enterprise. And the key to that is that if we do this well, we can really put the spotlight on economic inequality and its many different manifestations and meanings in order to drive together, and hardly alone, drive practical change for real people and real communities. And that's why in October, we announced that we had created our first big enterprise-wide initiative aimed at building an inclusive economy, one where every family, individual, community can give, gain, and grow. And we're calling that, as Ida said, the Aspen Partnership for an Inclusive Economy. This project is anchored by a $26 million founding investment from the MasterCard Impact Fund, transformational investment in the capabilities of the Aspen Institute pulled together to make a difference. I think that both Mike Froman and Marla Blow from MasterCard either are here now or will be here later today. So though I'm blinded by the light, let me thank you all, the two of you and your organization, for all you've done. Thank you. So we often call it API, Aspen Partnership for Inclusive Economy. API is co-led by Ida and by Dana Hyde, who's here today. Dana was the former head of the Millennium Challenge Corporation. She knows a lot about impact funds and about making big investments, helping make sure those investments have a great return. And what we're doing is we're convening all sorts of initiatives, projects, conversations among purpose-driven leaders from the private sector, with government, with nonprofits, to get to more inclusion. We're developing a lot of new proposals on financial security for workers and portable benefits, and ways to enable capital to small and medium-sized and growing businesses and communities, and with a great deal more to come, because really we're putting this across our institute, working in multiple dimensions. Our work in healthcare, education, financial security, corporate social responsibility, community-based solutions, all of it pulling it together under this theme of inclusive economies. And we think it's essential to consider the pillars of an inclusive economy in that comprehensive lens, in a spirit of optimism. We believe the solution should be co-created in partnership with those that have been left out. We don't believe there's such a thing as poverty-stricken communities. We believe there's poverty-structured communities, and so we can dismantle the structures that have led to inequity. We think of equity in terms of individual people and families and communities that have been systematically marginalized. We want to be part of a movement in which people feel safety and security at the household level and believe that they and their communities can determine their futures and live their fullest lives. We absolutely believe that diversity, equity, and inclusion, and looking at structural factors like endemic structural racism, are not the work of one time, but of all time. And we believe we need all communities, all people, all companies, all policymakers, all institutions to come together in a practical spirit of democratic fellow feeling, solutions-oriented. So today, as part of that broad partnership, we're so proud to host this convening with Prudential and to really work on the role of impact investment in building inclusive economies and creating a new capitalism. Couldn't have a better partner. Thank you so much. It's going to be, as a great kickoff to it all in a few minutes, we'll have a chance to hear from Wes Moore, the CEO of Robinhood, whose life story and whose leadership are so aligned with the values that bring all of you here today, making a difference for our communities and our world. And I know Prudential holds that set of values so deep to your organization. We were talking backstage a little bit about a choice that Prudential made, the choice to stay in Newark, invest in Newark, and help Newark develop the greatness in that community across all of its institutions, all of its neighborhoods, all of its schools. That was a choice. And, we don't celebrate choices like that enough. We kind of take them for granted once they're made. But way to go. That's such a big deal. And that really is exciting today. You've got a decades-long record of driving change and capital markets that leads to positive, measurable differences throughout our society. So with that, let me say I'm really excited to be able to introduce Charlie Lowrey, to invite you to come to the stage. He's been the CEO now for something like 18 months, I think, and maybe we started on the same day, which is why we haven't met each other until today, because we've been learning the ropes. But you, of course, years of work at Prudential, knowing the organization inside and out, and now driving the next chapter in this amazing institution's history in our country and in Newark and many other communities. It's really exciting to have a chance to think with you about the roles that you play and that capital markets play, that investment plays. So can I invite you, please, to come up here and share some thoughts. Thank you, Charlie, so much.
So Dan just talked about choice. You all have a choice as to whether to be here today or not, and you chose to be here. And that speaks volumes about why we're here. And I just want to say thank you on behalf of Dan, on behalf of the Aspen Institute, for your action, your commitment, your partnership to this critical work to drive inclusive communities. So thank you all very, very much for being here today. We're here to celebrate an important milestone, and that milestone is the building of a $1 billion impact investment portfolio at Prudential. And while this milestone, that's pretty cool. And while this milestone is a reason to bring us all together, what we're really here to do is to spend several hours learning from each other, sharing insights, and really setting a course for thinking about the future and work together going forward. You all, and I've read some of many of the resumes of the people in this room. I got it in my briefing package, and it is But you're the best and the brightest minds in the country in this work that we're doing. And it is such a privilege to have you all here today and with Prudential. We can learn so much by working together, by experimenting, by innovating, by trying new things in partnership with each other as we go forward. You had some of the sessions this morning, which from what I hear, were very, very valuable. And through our collective learning, we're better positioned to lead and to pioneer solutions that no one thought was possible, that no one had thought of to this date. My hope is today that we can deepen our partnership with the Aspen Institute and with all of you as we go forward. So for Prudential, our corporate purpose, and we have a very specific purpose, which is to make lives better by solving the financial challenges of a changing world. And this purpose reflects our belief, held through 145 years of our history in Newark, New Jersey, that corporations and communities can advance together by working together. Businesses like ours that are focused on the long term, inherently must care about societal issues, as those will inevitably impact our business as we think about our business 10, 20, 30, 40 years from now. Because in the long run, we know that our engagement, our real and substantive engagement on these issues will benefit our shareholders, our customers, our employees, and the communities in which we live and work and help. And one of the ways in which we make lives better is by bringing a wider, more diverse set of financial wellness tools to a wider and more diverse set of people, offering underserved and middle-class Americans ways to improve their lives and maybe just a little bit reduce their stress. And our impact investing portfolio has been a key driver of that innovation for Prudential, with investments that provide access to credit, to affordable housing, to education, amongst many, many other things. We help find, fund, and incubate unconventional solutions to societal and to business challenges. We amplify the efforts of these extraordinary and innovative organizations, many of whom are in the room today, that are finding new ways to help financially vulnerable people on their path to financial wellness. We support entrepreneurs who are developing quality places to work, to live, and to play in historically distressed areas. And if you look around places like Newark, New Jersey, or Baltimore, Maryland, or El Paso, Texas, or in many of the emerging markets in which we work around the world, you will see tangible, visible evidence of our leadership in being a catalyst for positive change. Working with partners like you is indeed a privilege, and we're able to create outsized positive impact, not only in society, but frankly, in Prudential as well. We're generating investment returns. We're discovering invaluable consumer insights, attracting new customers, and opening doors to new revenue streams and market opportunities. But perhaps most importantly, through this work, we're providing employees with a true and meaningful sense of purpose. So with a conviction that we all need to share collective learnings and to continue to innovate together in order to generate greater financial security, we'll kick off the programming for the remainder of the day. So thank you again for coming. And thank you for your interest in and dedication to what we're all doing together, because we believe, and I personally firmly believe, that little by little, we will make a difference, and we have to make a difference. Thank you so much.
Welcome and good afternoon. I'm Andrea Kaufman and proud to be a part of Prudential's Impact Investing team. I'm excited to introduce today's keynote speaker, Wes Moore. I got to know Wes several years ago when Prudential was considering an investment in the company he founded, and I was intrigued by the business. But what hooked me was this entrepreneur's passion and vision, his desire to do good. I knew at the first meeting, whatever Wes pursued, he was going to make a difference in the world. Wes was raised in the Bronx and Baltimore by a single mother, and his accomplishments are many. Phi Beta Kappa from the Johns Hopkins University, Rhodes Scholar, paratrooper, New York Times best-selling author, and now CEO of the Robin Hood Foundation, one of the largest anti-poverty forces in the nation. Incredible, right? We invited Wes here today because we believe he embodies the spirit of the future of capitalism. His journey represents the potential for economic mobility fused with a moral imperative to do good. Please welcome Wes Moore.
Good afternoon. Andrea, thank you so much for the introduction, for your friendship, and for your leadership. You, the entire team from Prudential, have just been unbelievably supportive of everything we've been involved in, so thank you. And to the Aspen Institute for your leadership in making this happen. I mean, to get a room like this, a room of social entrepreneurs, a room of foundation execs, a room of people who are in the financial industry and people who are on the ground, actively focusing on an issue that frankly should be keeping all of us up right now. And that's the fact that we need to have a very sincere discussion about the disconnect. And that the disconnect is real. The fact that how do we have a structure in a society right now where we know that two polar worlds are moving forward at the same time, yet those two polar worlds are in actual conflict. The reality that we can have indicators that point towards the fact that we can have a 3.7 or 3.6% unemployment rate. But we also know that the vast majority of people who are the ones living in poverty in our society are the working poor. People who are working not just one, but in many cases, multiple jobs. The fact that we can have growing GDP and the fact that we can be in the process of a large and expensive bull market, but at the same time, I know with our work at Robinhood and the partnership we have with Columbia University, where we have something called the Poverty Tracker. And the Poverty Tracker, in fact, just last week, the data showed us that 50% of all people, all New Yorkers, over the past 4 years have been in poverty for at least a year. 50%. Not half of a borough, not half of a jurisdiction, not half of a demographic group. Half of the city. We're here to have a conversation and a discussion about the disconnect. And the disconnect that while these two things move together right now, it's not only unsustainable, it's immoral. How we are not having a more inclusive conversation when we're talking about the wealthiest country at the wealthiest time of our nation's, of the world's history. You know, I think about it in context of my hometown, which is the city of Baltimore. And in fact, in the spring, I have a book project that'll be coming out where we talk about, it's called 5 Days, and we talk about 5 days in the life of Baltimore, and all hovering around the uprising and the unrest that took place around the death of Freddie Gray, a 25-year-old young man who made eye contact with police. He was arrested. An hour after he was arrested, he was in a coma. A week after he was in a coma, he died. And I remember having a conversation with someone who's actually a minister down in Baltimore. And we were talking about policing and police accountability and that type of thing. And he asked me to do something. He said, Wes, he said, do me a favor. He said, next time you get in front of a computer, go to YouTube. And he said, and go to YouTube and look up Freddie Gray's arrest. And I told him, I said, listen, I've seen that video 100 times because it's all over the internet. I said, I don't need to see it again. And he said, I understand your point. He said, listen to me. Next time you get in front of a computer, go to YouTube and look up Freddie Gray's arrest. But I ask you to do this. Next time you look at his arrest, don't look at Freddie. And don't even look at the officers. Look at everything else. Look at the neighborhood that that video was shot in. Look at the homes in the background. Look at the fact that that video was taken at around 9:11 in the morning, and how many people are just standing around. His larger point was, we cannot mourn the micro if we're not willing to do something about the macro. His larger point was this: in order for us to have a real conversation about the future of our society, we need to delve deeply into many of the topics we're going to go over today. Topics such as, are the indicators that we are looking at right now that show our economic health, are they really telling the true story? And are these the indicators that we should actually be thinking about and trumpeting? Because the things that we measure are the things that matter, and the things that matter are actually the things that should be measured. Topics like, how are we making sure that the community is as involved in the conversation, and that they are part of the conversation and not just subjects of the conversation? That in many cases, the solutions we are looking for already exist in the communities that we are trying to serve. And our job is to be able to share that autonomy and share that power and to listen. Deep conversations like understanding how all of our industries, every single one of us, those in philanthropy, those in the financial sector, those who are based in doing the CBO work, those in government, how we all have to be honest about our own levels of complicity in this. That there's not one group nor one area that's been responsible for the functional breakdown in the lives of so many of our neighbors. The fact is, we have a fundamental breakdown that has existed in the lives of so many of our citizens and in so many of our communities, and the only way to address a fundamental breakdown is a fundamental build-up. Knowing that there's not going to be one group nor one person that's going to move us out of this, but that we all have a collective responsibility to play our part and to play our role. And to take everything that we've been doing now and not just do it better, but to fundamentally ask the question, what else? What else can we push? What else can we stress? What other partnerships can we create? Because the future of everything that we hold true, the future of every single hope and dynamic that this country in its documents have promised to offer to all people, the truth is we have been amazingly miserly and arbitrary as to how those blessings are allocated. Our moment now, our time now, and the data is screaming at us to address it, means that while we might not be responsible because of the seats that we sit in for where we are right now, if we continue to have this as a challenge, if we continue to have this as a problem, if future generations are dealing with the dynamics of the disconnect that we will discuss today, that is on us. That's our cross to bear. Because the reality is each one of us now sit in seats to actually do something about it. And to make sure that these things that are conversations become action plans. And those action plans become movements. So I'm incredibly thankful for the time today, but more importantly, incredibly excited for the action tomorrow. Bless you guys, and thank you so much.
Safe travels.
Thank you, Wes. There's now a quick costume change, or at least bringing up the panel there, and Wes is on his way to a train, but we're so appreciative of him joining us. We structured this as a first couple of pieces of the conversation about what we've been calling in the off-agenda lexicon, the big why. And if Wes gave us the moral imperative for change, our next panel is going to talk to us about the market imperative for change. So to kick us off with Capitalism at a Crossroads, I am so happy to present Kimberly Adams, who is DC correspondent for Marketplace, and take it away. Thank you.
Thank you. Good afternoon, everyone. I'm so used to doing these things in the morning. Good afternoon, everybody. Thank you all so much for being here, and I am just so happy to be here with this amazing panel. We have Jean Case. She's the chair of National Geographic and CEO of the Case Impact Network, and Kathy Clark, who's the director of the Center for the Advancement of Social Entrepreneurship at Duke University, and Martin Whitaker, founding CEO of Just Capital. Thank you all so much. Jean, can I start with you? We have a presidential election going on, and obviously in a campaign, it's so easy to say, here are the winners and here are the losers, and if you're the losers, I'm gonna help you out. This is playing out as a debate between capitalism and socialism. What does it tell us about the economic moment we're in right now?
Yeah, well, it might be. Good afternoon, everyone. It's a real delight to be here, and thank you, Kimberly. You know, it might be helpful maybe to start with some data just to level set us, because we are in this broader political environment. We also are in a broader economic environment, as we know. So there's some research that's come out of late in 2019, one being the Edelman Trust Barometer, and if you follow that, you know, CEOs really pay attention to that, and leaders across the country do as well. And you know, one of the troubling points of data, there were two actually, that I found really significant. 51% of the people interviewed said they have a belief that capitalism does more harm than good. And 1 in 3 people surveyed said they don't believe their lives will be better 5 years from now than they are today. Pew did some similar research looking at these words and these choices that people think they have to make. And 42% of the respondents said that they have a positive view of socialism. So we really are living in a time, I think, where people see it's socialism or capitalism. And I think hopefully what we're going to talk about on this panel today is maybe that's a false choice, actually. Maybe we can reimagine capitalism. You know, can we look at who's being served well and who is not, and look at fundamental changes we might make to our system?
Martin, you do a lot of polling at Just Capital of how people think about what businesses should be doing in this economic moment. Can you talk a little bit about that?
Sure. Thank you. Very grateful to be here. We know that, so we 6 years now worth of survey and polling data all around the country. We're doing our focus groups for 2020 this week. We've heard, really for 6 years now, that we have a lot more in common than you might think. No matter what your income, no matter what your geographic, economic status, gender, race, doesn't matter, people tend to want similar things. We found really people want businesses to pay a fair wage, to look after their workers, to invest in the communities where they operate, address their environmental impacts, support communities, customers. So it's a very consistent roadmap for how business today can really operate and restore some trust among the public. I just want to come back to this because it relates to the democracy versus socialism, capitalism versus socialism issue. It's interesting that this panel is the sort of the financial case. And the previous Wes was talking about the moral case.
Yeah.
I don't see a big distinction, actually. Those two things must converge. Capitalism is essentially a moral undertaking. Smith's theory of moral sentiments was 17 years before Wealth of Nations. And I think we would do well now to look back on the purpose of a corporation, which obviously we'll talk about, the Business Roundtable. How do you restore some faith in the institutions of capitalism and big business? And how do you create within people a sense that they have a stake? Because when you don't feel as though you have a stake in something, that's when you end up with the polarized situation we live in today. So I think those two things are connected, and I think we must try to think about them in a more connected way. And the survey and polling work that we do, to come back to your question, just presents a very clear blueprint for how business today can reconnect and can serve more and more people.
Kathy, at Duke University, you do a lot of with impact investing. Can you talk about what impact investing is and how you're training people to do it?
I can. I'd like to go back, if I could,
Yeah.
and comment on some of the previous conversation, because I feel like what we're seeing, whether it's through our polling or through our politics and some of the great data points that Jean was showing, I think we're seeing that there is a perception, whether it's among students, whether it's among everyday people, that the system of capitalism that we have set up is rigged against them. That's where the lack of trust is coming. And when you go back historically and you look at what historically, when people were applying for business charters, I looked up today, the Dutch West India Company, right, one of the first companies in 1621 applied for a business charter. The language in there is because we're going to serve the welfare, the general welfare of the inhabitants of this community. Business was always designed to have a common purpose.
That's in the preamble to the Constitution
It
as well.
is, exactly. But today it's perceived, perhaps rightly so, in the way that it's been interpreted, which is we have to maximize the benefit of one single stakeholder, who are the owners and the shareholders. And so it is not that surprising that there is discomfort with that, distrust with that. And I'm just going to be a little radical, which, you know, when I say this and I wish I were a tenured professor before saying it, but here goes, which is I just think we got the source code wrong for capitalism as a whole, and society is telling us that. We know that the 1% owns 50% of the wealth in the world. How can that possibly be okay going forward? That's up 5%, thank you. That's up 5% in the past. Is this on? It's up 5% in the past 10 years. If that continues, I mean, we can't let this continue. And so when you come back to impact investing, I think impact investing has been an R&D lab. It has been an R&D lab around what is the power of business to impact different stakeholders in a more authentic way. And when you have it being done by individual companies working directly with communities and paying attention to the feedback loops of what those communities are getting out of it, you can learn things. And so I feel like what we're seeing now, which I'd love to delve into more, is the idea of impact investing, which is obviously investing for a financial return and some impact, and the larger capital market, which is becoming cognizant that it is having impacts on all sorts of stakeholders that it is not having feedback loops on, are starting to converge. And the optimist in me says, great opportunity.
Yeah, I think that's such an important point that you made, Kathy. I think of it as we have to go back to the future. Because if you actually look at companies that were known and brands that were known in the first half of the 20th century, they were very much focused on multiple stakeholders. It wasn't a perfect society, but IBM in 1935 was among the first companies to make equal pay for women. Long before there was a civil rights movement, they stood up against segregation in the South. Not something necessarily that they would say was intrinsic to their business to stand up and use that voice. You know, one of my favorite things is Hershey, Milton Hershey, who knew to attract workers out to a place in Pennsylvania where there was no city and not a lot of resources for them, built not only housing for his workers, but what we know today as Hershey Park actually started to be entertainment for the workers and their families, because he understood asking them to work far from a city might be a challenge. So, you know, it's funny because I was talking to Ginny Rometty recently, who of course runs IBM, and she said, look, if you look at companies that have been around for 100 years or so, this idea of stakeholder capitalism is not radical at all. In fact, it's kind of how many companies did business in the earliest days. It really wasn't until the 70s or 80s when we began believing, for some reason, that we only could have one focus, and that had to be shareholder return. I think we have to recognize we can walk and chew gum at the same time. These companies can build great companies and return a profit while at the same time looking at how to serve more people in more places.
Which leads us nicely into the discussion of the Business Roundtable statement that came out and said that companies should and are starting to look at a variety of stakeholders, and that shareholder value should not be the supreme focus of business moving forward. Why, you guys have all been working in this for some time. Martin, why is this catching on now? Jean was just talking about how it wasn't until the 60s and 70s that we really made that departure. Why are we coming back to this now?
I feel left out. Do I need a mic or is this working?
We can hear you.
Okay. Okay, no,
We won't make
I'll
any
just keep
gender
going.
comments.
Only the cool kids
no,
get
it's
the
good.
mics.
No, I think
Only
it's
the cool
working.
kids.
A couple of things are happening. One, explosion in ESG investing. So we're seeing billions and trillions of dollars flowing into that. We can talk about the meaning of that and...
Go for it.
Well, you worry that, to what end, right? So that's great if it produces outcomes, if it's done well, if we're measuring, as Wes says, what matters. ESG investing has to improve in order to take, otherwise it's just a marketing wrapper and an asset gathering exercise. So there's got to be a lot of substance behind that. Nevertheless, I believe there is in many cases. So more and more investors want companies to think about their role in society, around their impact on the climate, around their impact on income inequality. More and more activism among not just investors, but among workers. You see that with workforce at Google, you see that with Amazon, big companies. So people feel a lot more empowered. One of the missions of Just Capital is to provide the market with the data that it needs to engage, to become active as a consumer, as an investor, as a job seeker, et cetera. More and more people entering the workforce seek a job and want to work for a company that aligns with their values. So the war for talent is compelling companies. So there's a confluence of things happening, which is making purpose the competitive frontier for business. It's how you win and lose. So the stakes are really high. So I think that is what's actually happening. And some CEOs, I agree with you, have been ahead of the curve, thinking about these things for a long time. Others have not, and are now wondering what the hell's going on. Mm-hmm. So as with anything, you have this continuum. The Business Roundtable's restatement of purpose to create value for the different stakeholders is a marker. It says, I'm the CEO of a company. My purpose now is to create value for all of these stakeholders. So great. Now the question is, now what are you going to do? How do we know the value is being created? And by the way, what does that even mean? How do you measure value creation for the communities where you operate? So I think this is a really exciting moment to ask some serious questions, to get it out of the realm of, general conversation to, okay, where's the rubber hit the road on this? Because I think investors are going to want that. I think companies are going to want to see that if they're serious about competing effectively. Same way you would measure other stuff that helps you compete effectively. And other stakeholders now are saying, excuse me, how are you creating value for me? Show me that that's happening. So I think all of that is happening. That's why I'm excited about where we are. And I feel as though this is really a moment where we have the chance to create something of great substance.
But it's really easy to say that, that we are going to care about all of these stakeholders. And like you said, people are going to start demanding accountability. What have we seen so far?
Well, I think there's a great example in Airbnb, because after the restatement of purpose of business by the Business Roundtable, Airbnb came out and said, you know what, we're taking this really seriously, and we think there are some fundamental ways we can manage our business to make this real. So they were the first company to appoint a stakeholder committee on their board. And that stakeholder committee is more or less holding their feet to the fire. In addition, they looked across their organization and said compensation structures now are not just going to be based on how well the company is doing in returning a profit or looking for a profit. It's going to be based on how well we're serving multiple stakeholder groups. And those would include not just their employees, but their customers as well. And those are measurable. In many cases, employees can vote with their feet before you even ask them what they think. Are they staying in the job? Are they, is the labor pool pretty constant? But then, of course, asking them what they think is a radical concept to get the view, but customers as well. So they're really trying to operationalize in their company how they're going to take sort of this idealistic thing and turn it into the way they operate as a company and how people get paid and rewarded.
Can I tell two very quick stories on that?
Very quick.
One is PayPal. Dan Schulman, CEO, realized most of his call center workers in Omaha were under financial distress, and the business was suffering. So he raised wages, lowered the cost of benefits, gave them stock ownership, and wrapped the whole thing in financial education plan. That's the playbook for how you deal with employees that are experiencing extreme financial distress. The other end of the spectrum is there are millions of workers at Russell 1000 companies who are on food stamps, right? Who are experiencing extreme financial distress. That's just not right. At a large cap company that you are essentially being subsidized by the taxpayer. So you've got this. This is why measuring this stuff is really important.
But Kathy, when you're training people in these new ways of thinking about capitalism, about basically this argument that we should realign the way the economy works and that this old model doesn't work, that we need to change the source code, how are those conversations developing? Are people buying in?
So the next generation of leaders that I have access to, which is MBA students primarily, they are very, very skeptical of talk without walk that comes from CEOs or others. They are, I think the research is 88% of them will only work for a company that aligns with their values in some way, which is a very large number that most companies are paying attention to. And they are looking for ways to find companies that they trust and that they can help influence. They are not necessarily at the level of the source code, right? They are not in the right echelon of the levers of power and control to directly impact that, although some of them do over time, right? Which is one of the most satisfying things as an educator, is to watch what they do 10, 20, 25 years out. I think the other thing, though, is they realize that until we, as both Gene and Martin have said, until we change the way we account for other stakeholders, there's just too much room for greenwashing and impact washing and slippery talk. And it comes back to what the former speaker was saying. You need to measure what matters. And right now we are beholden. It may have taken, we were talking before, how long did it take us to develop our financial standards, right? It took more than the 30 years that we've been talking about impact investing.
You mentioned a word that I think is really key to this conversation, which is trust. And if in recent decades we've had sort of this core group of people making decisions about the economy that have created this dynamic where so many people feel left out of the financial system, feel like the top percentage of people in terms of wealth, in terms of leadership at corporations, are simply running this economy to benefit themselves at the expense of everyone else. Many of these people are the same people who are running the venture capital funds that are doing impact investing, that are running the corporations that now say they're on board with this business roundtable agreement. In this sort of angry pushback to the system that exists, why should people trust that these same people are now going to suddenly make decisions that are going to be better for all of these other stakeholders?
I think it's a really fair question. What I will say, however, is there are dramatic demographic shifts that have taken place among what the American worker looks like today, and we haven't gone nearly far enough. But the presence of women and people of color in the workplace, and particularly, even if there's only one on the board or one in the C-suite, the dramatic viral effect that has on expanding that pool and broadening perspectives and covering blind spots. And I think until we see more diversity playing out in a very real way, diversity because it's a social justice issue, no question, but diversity because time and time again the data is coming out from the same consulting firms that the Fortune 500 hire every day to consult with them. It's making clear that where there's diversity, there's outperformance. And in addition, open to innovation, open to change. And those are some of the same voices, I think, that are driving what we're seeing today. As Martin said, CEOs, it is about a battle for talent. And CEOs know they need to attract the best and the brightest. And they can't be playing one game over here and thinking they're going to pull in some of the best and brightest from some of those segments if they're doing that.
But that's a business argument for diversity and inclusion and impact investing, which in a tight labor market, sure, you're going to do what it takes. But if there's only the business argument and not that moral argument that Wes was talking about, what's to say in a different economy, those incentives go away?
I think it's a real question, and I totally agree with Martin's original point, and Kathy underscored it. You really can't separate the justice issues, the moral issues, from the business imperatives here. I guess what I'm most thrilled about is the data is coming out that what seems to be just and moral has tremendous business benefit too. So for the skeptic CEOs out there who otherwise wouldn't come to the table, they can now see a path forward to making these things a priority.
Isn't it a myth that I have to either serve my shareholders or my other stakeholders? It's a zero-sum game. I mean, I just don't buy that. I think the data, and I'm not saying across the board, this is easy, but I think that is a myth that needs to be exposed and overturned. And I think one of the things I've learned doing Just Capital over the last 6 years is it's not enough to put the data and the measurement and all the analysis and the research out there. You have to have human stories. You have to shift the narrative. You have to really talk openly about what's working and what's not working. That's how you build trust, right? Transparency. Deepak Chopra, who's one of our founders, talks about Just Capital being like switching a light on in a dark room. People behave differently. You can see what's going on. So we need to try and bring more transparency around corporate performance and what they're actually doing to support and create value, in their own words, for stakeholders. And that's not necessarily one at the expense of another. That's the narrative that needs to be shifted. That actually, if I'm a smart investor, I need to be investing in a company that's doing really well and creating value for all these stakeholders. Why? Because that's the pie growing for everybody. And right now, that's not a dominant narrative. And at some point, when it becomes the dominant narrative, it's not going to be sustainable investing. It's not going to be justness. It's going to be what we do. And that's where we need to get to.
I completely agree with that. I just want to say, the analogy that I mentioned before, that impact investing and social enterprise being a little bit of an R&D lab, this isn't new. Right. We have been building and experimenting with how corporations can address the needs of stakeholders for at least 15 years through the form of B corporations, of certifying companies for the transparency that they share on their practices as they address the needs of various stakeholders. And what's interesting about that, I was part of the original team that put that together and have been watching it expand ever since. Those tools are now used by over 100,000 companies. The certification and the corporate form that has gone with it has expanded dramatically, not just in the US, but around the world. Because people are saying, we can actually change the expectation, the legal expectation of fiduciary duty around these things, and then we can create a community that learns, what did Airbnb do? What did PayPal do? Right. How do we share that with each other? So we're just not at ground zero. We've already had 15, 20 years of experience in doing this in a deliberately, regulatorily supported way. And what's interesting is seeing that there are, along with the Business Roundtable, there are multinational companies who are now coming and saying, that is a framework that we want to adopt as well, because we think it will help us, it will contain our interests, and it will allow us to do the work that we want to do.
And some of this is about timeline as well, the emphasis on short-term results and short-term outcomes for a corporation, the kinds that show up on your quarterly earnings reports that we love to cover so much in the business media, versus a long-term strategy, because the investments that you all are talking about are going to cost money up front or may affect the business up front. But how do you make that argument to sort of the fast-moving, fast-paced market analysts and CNBCs and Bloombergs and marketplaces of the world to look at that longer term outlook?
Well, I think it helps a lot that the world's largest asset management company, their CEO, has called for long-termism in their investments. And it's actually a small number of, firms that hold a significant amount of the capital out there, and they're using their voices. Larry Fink has been out there time and time again calling for long-termism. And one of the things I'm encouraged by is the SEC approved something called the long-term stock exchange, and that's going to be available for companies who put up their hand right out of the start, and they say, look, we're not going to play that quarterly game because we're not sure that leads to the best priorities of a business. And they have a kumbaya moment between the investors in that business and the business itself. And I think some of these movements are easy to miss, in a world where there's headlines every day. But some of them could be really significant in terms of shifting how business operates in the days going forward.
So yes, absolutely, 100%. And you got it focused on short term as well. And I know that Gene and I agree on that. So one thing we've done, to be very specific, is to go to CNBC and have what's called a quarterly just call, where CEOs go on. We've done 3 of them now. The last one was with Hewlett-Packard Enterprises. And right there and then, you're talking about why does this matter now in the next quarter? Why are these things we're doing to invest in the environment, transition to a low carbon economy, invest in our workforce? Why are those relevant to investors? Why should they care? And that's really interesting. I mean, and the reason why we do that is because, to your point, you need to begin to try and speak in a way, in a language, in a framing that investors today are used to. So you need to do both of those things, and I think it's sort of, it's hard to actually make the short-term case for stakeholder performance, but that is the discipline that's required. What is the ROE of investing in my workers, right? If I've just said I'm going to create value for workers, I'm a BRT CEO, how am I measuring that? What's the ROE?
All of the acronyms.
Well, and
Sorry.
I think, so
LOL.
I think, Martin, we were talking earlier before the panel, and we see a lot of companies right now, particularly in the environmental or carbon front, talking about going carbon neutral. And the dates they're putting out there are 2050, 2040, and that's very admirable. But to Martin's point, I think what we have to do is make sure they're walking that walk right now, with clear measurements right now, short-term things that can be done to start to bend towards that 2050. And there's an electric company out of Detroit that made a long-term commitment, and what they found was when they made it more of a short-term priority, they're going to blow past that long-term date. I mean, they're going to deliver like a decade early. So I do think, to your point, there's short-term, there's long-termism. It's not necessarily one or the other. You can be long-term focused, but make sure that you have an action plan now to begin to get there.
If you've ever run a marathon,
I won't know.
it's like, no, if you have.
I don't plan on
I'm not
Never watched
Have you ever been asked that on stage before?
Sorry, that wasn't scripted, obviously. I said, if you're going to run a marathon, if you ever run a marathon, you break it down into these little short-term goals. Right? That's what
exactly
you do.
right.
That's how you get through it.
Yeah. In a moment, I'm going to turn to the audience. We only have time for 2 questions, so if you've got something burning in your soul, wave frantically in a moment. But I'd like to run with you guys a quick sort of mental exercise for us here. Yesterday, I was listening to the hearing on Capitol Hill about our preparation for coronavirus, and one of the topics that came up was, if and when there's a vaccine developed or treatments that are found to be effective, will it be affordable? And the Secretary of Health and Human Services said he could not guarantee that because he didn't want to interfere in the private sector and their development and the incentives for research and development. Can you guys walk us through, if we look at this situation from this new idea that we should care about stakeholders, but also care about running businesses, how we can think about this and what advice you might have for the companies involved in this.
That sounds like a Kathy question to me.
Yeah, Kathy, you haven't talked
me
in a
on the
while. Go
spot.
for it.
Thanks. I think that there are going to be tough choices that companies need to make and that societies need to make, and that's the role of government. It should not be abdicated, it should not be minimized. That one of the most important roles of government is deciding when is something is just in the interest of everyone. And we need to hold our elected officials accountable to thinking about the general welfare. Now, at the company level, when you're trying to maximize benefits for all stakeholders, there are going to be trade-offs. I don't think we as a society have learned enough about what we should expect from those trade-offs. What are the circumstances in which the beneficiary's rights should supersede the rights of a supplier, for example, who may not get paid at a lower price, right? What are the rules of the game for that? That's what I mean by being in R&D mode still. We don't have this down, but we're gonna have to figure it out. And crises like viruses are a great example of when we will scramble and we will figure something out.
Yeah, and I think we've all worked on cross-sector initiatives, and this is clearly going to be one where you can't just say it's the business to bear the burden, it's the government, or it's nonprofit. You know, one of the ways we saved tens of millions of African lives was through our PEPFAR initiative, and I had the benefit of working in those early days, and there were CEOs who came to the table and really made their drugs available at almost no cost, because it was urgency conquering fear. It was, this just is the right thing to do. And by the way, it's a lot harder to run away from doing the right thing if you're around a table with others calling each other to a higher place. And I think what we'll see in this is it's going to have to be all in, cross-sector, not waiting for one actor or the other to do the right thing.
I don't think we need the coronavirus to tell us that drugs are not affordable for most millions of people. One of my kids is a cancer survivor, and we saw firsthand in that war, like the cost of those drugs, who could get them, who could not. I mean, it was not pleasant. So I think this is just, if this shines a light on that issue, great.
But it's interesting, if you Google today, if you're interested in getting the face mask, gouging is already occurring. It's incredible what you're if you've looked at, well, gee, should we get some just to have them in stock or whatever? So it's going to take an all-out effort, and we're nowhere close to where we need to be.
And we're also not China, where we can just say, this factory is now going to do this. All right, wow, all the way in the back, you jumped right up. You ask your question, and then we're going to take the second question and get you guys to respond to both of them. So go ahead.
Hi, thank you all for being here. My name's Rebecca. I have been a social entrepreneur for as long as I can remember. And I guess over the last 10 years of raising impact capital, I've heard so many different versions of we don't have to sacrifice our values for value. And I'm just wondering if that's really true. What if we do have to take concessionary returns? What if we do make 10% or 20% less? Wouldn't we all still choose to do that? And my answer personally as a CEO would be absolutely, of course, because so much is at stake. Yet when you talk to Josh Bolton and BRT to this point of thinking about putting some teeth in that statement, there's a huge resistance to the idea of pricing any of those ESG metrics into a stock price. So my question for you all is, how do we move LPs and those who are kind of in charge at the highest level of corporations in dictating what the incentive structures are that drive our CEOs, that drive our investors, to give everyone some cover to actually prioritize impact and solving problems over profit?
Okay, hold on to that. We're going to get...
It's a great question. Good question.
Thank you for that question. Hold on to that in your minds. And then what's our second question? No one else in this entire crowd? All right, let's just do that. Go for it, Kathy.
I'd like to jump in on that one. So this is going to be a wonky answer, but I'll get to your,
Yes,
right? I'll get to your
for it.
thing. So I've spent the last 4 years supporting some of the work of the Impact Management Project. How many people in the room are familiar with that acronym, Impact Management Project? So very few. So almost about 30% of the room. The Impact Management Project was set up a few years ago to try to say, what are some of the common dimensions of reporting on impact that we know we have 40 plus different ways that people are measuring impact? What are some of the common dimensions that can be passed along? And if we understand those common dimensions, can we classify the kind of impact that we are trying to do? And this was an idea that I and another colleague, Ben Thornley, had. Maybe we should have impact classifications to go alongside asset classifications to say, you know, maybe there are common characteristics among certain kinds of impact investments that should dictate our expectations about not only the kind of impact that we have, but the level of granularity of information that we should expect or pay to get back from those investments. And so relating it finally back to your comment, we have created a new set of impact classifications. And one of those characteristics is this a market rate instrument or is this a concessionary instrument?
And because are people using those?
What's that?
Are people using those?
People are starting to use them, and they're starting to create a database where people are classifying their impact products. It can be anything. It can be an ESG product, it can be public, it can be private, it can be anything by these classifications. So what that allows to do is for the entrepreneur in the back of the room who wants to say, I want to be held accountable for my impact, and at times I will make trade-offs with return. I need to have investors who align with me on that, so that we can make a marketplace that can find those more easily and stop arguing with each other. I think all of them should be this way, and I think all of them should be that way. That is not getting us anywhere. So I feel like it's a little bit of wonky infrastructure that will hopefully allow this marketplace to continue on the path that it's on, but allow the different flavors of impact to thrive.
So the different forms of capital, from philanthropy, which is ultimate concessionary capital, through to, let's say, market rate, that is available whether you're an impact investor or not, right? So whether an impact investor has to take below market returns, if they choose to do that, that's great, that's fine, that's up to them. What I'm saying is, if you say, I want to have market return, easy. And I'm also saying, actually, you can do that really badly and generate neither competitive return or impact. So there is a continuum of performance across both impact and financial spectrums, which, I don't know your fund, but if you're going to be in there somewhere and some provider of capital is going to say, that's what I want because it solves a problem for me. Now, the way the real essence of your question is cost of capital. Philanthropy is free. If you are, okay, maybe not free.
I feel like I'm writing checks there too.
In terms of a financial return.
Yes. 100% capital loss is the way to look at that.
Yeah, thank you. So you are seeing debt now tied to ESG performance. JetBlue's ESG credit facility this week's good example of that. I think that's the thin end of the wedge, and you will start to see corporate credit as it's rolled over. Corporate paper is now going to be priced with a view, depending on the horizon, which back to the short, long term, of the investor. Mm-hmm. You see it in equity markets. When I was in private equity, absolutely, we're looking at risk, looking at opportunity. You price those into your discounted cash flow analysis. So I think it is happening. It's not happening fast enough, but I think it's happening. And with more data and with better analysis and more folks thinking about this as part of their investment calculation, it's going to accelerate very, very quickly. That's my point.
Okay, I'll be really quick. I see we have like 10 seconds left. All I want to say to this audience is it's very easy to look at the world today and say, well, that's how it works. I think what we're here to challenge all of us to do, including ourselves, is what kind of world do we want and what does that look like? When I was teaching at the School of Management at Yale, this guy raises his hand and said, I just tried to figure out, why would you only settle for a financial return? And I think that is a really great question that we should all ask. Why can't we have a financial return of any kind and ask for a lot more from our capital at the same time?
Jean Case, Martin Whitaker, and Kathy Clark, thank you so much. And thank you all for your attention. We're going to go this way.
Hey, how are you?
Thank you.
I teed it up for you.
Okay, thank you so much. That's great. For those of you interested, that was a great conversation. It's just a taste. We're actually going to be doing a whole track at the Ideas Festival this summer called A New Capitalism. Some of the same speakers, some of the same themes, and a whole lot more. So there is still tickets available. Happy to talk to you more about the Ideas Festival. But we're really excited about drawing a through line through a lot more of our platforms on these issues. And speaking of through lines, Kathy Clark talked a little bit in the last time about the foundational work she did with B-Lab. And so now I'd like to introduce to the stage Andrew Kasoy, who's the founder of B-Lab.
Hey, everybody. Having watched Michael Bloomberg bomb a couple of short jokes, I'm going to not... I'm really honored to be here. Both of the co-hosts of today's event, both Prudential and the Aspen Institute, have been really catalytic supporters of the B Corp movement since the beginning. And they rank right up there with my Grandma Ruth, who on her deathbed gave us our first $30,000 grant. And I'll talk a little bit more about the catalytic roles that they've each played as I'm going through this. But it's a really, I'm honored to be here, and thank you. I also think it says a lot about the moment that there's such a large gathering of people who actually want to talk about a new capitalism. For most of the last 13 years, every time we wanted to have a conversation like that, there were like a large group meant like 2 or 3 people. So I just wanted to take a couple minutes and talk a little bit about background, because I'm not really like a likely person to be on this stage talking about building what is actually a social movement. I'm a private equity investor by background, and I spent 16 years making private equity investments on Wall Street. And I loved the rigor and the analysis and the strategy of making those kinds of investments and the relationship building. But I also came to doubt over time the increasingly single-minded focus on financial return in a financialized economy. And I want to be clear, I'm not just talking about like short-termism, but equally this long-term belief that the only thing material is financial returns, what I would call shareholder primacy, as if human aspiration or social justice or the planet existed only to serve capitalism as opposed to the other way around. And I came to start to see this as a systems failure with capitalism, likely not only to continue to leave behind so many marginalized people who capitalism has never actually served very well, but also ultimately to destroy the very system that has successfully lifted up billions of people out of poverty. The Crown Fellows program at Aspen and later the McNulty Prize at Aspen were 2 things that actually helped along in that journey. And actually gave my 2 partners and me just enough moral courage to leave what we were doing in order to start B-Lab. And so in 2007, the 3 of us started a nonprofit, and that nonprofit was focused on this idea that there might be a better way of running the economy, that we might be able to build an inclusive and equitable or regenerative economic system for all people and for the planet. So I'm thrilled we're talking about a new capitalism. It's interesting to me that a very similar conversation is happening in a lot of other places around the world. I would say primarily in pretty elite places. And so whether it's the recent convening in Davos or what we just said is going to happen at the Ideas Festival around this idea, or just about every major financial media platform having some series about reimagining capitalism or reinventing capitalism, or Larry Fink writing a letter to CEOs, or the Business Roundtable's recent declaration by 183 CEOs about stakeholder capitalism, or lots of billionaires who are fretting about the fact that capitalism isn't really working in the right way, or we need to reinvent it or reboot it. You can question whether they want to do that because they're patriots or because they're worried about the pitchforks, but one way or the other, it's a big conversation. And I think really importantly, policymakers. And it's not just policymakers on the left that are talking about the challenges of capitalism. From Josh Hawley to Elizabeth Warren and Mark Warner and Marco Rubio in between, there are a lot of politicians talking about the ills of shareholder primacy and looking for solutions. And at the heart of all of those conversations, I think, is a recognition of system failure. So the question is, how do we change the system? Or like a different way you might put that is, how do we have a capitalist reformation instead of a bloody populist revolution? And our view at B-Lab is that systems change, and this is like the theory of change language, requires three mutually reinforcing and interdependent threads that have to be woven together. That's what it's going to take to address the source code error of capitalism that Kathy Clark talked about, shareholder primacy, and replace it with an economic system that's actually creating benefit for all stakeholders, not just for shareholders. And those three things, as we think about it, are culture change. Like, we need to change the norms, the expectations of what the purpose of business is. The second thing is behavior change. Like, we actually need to see businesses changing the impact that they have on their most important stakeholders. And we need structural change, meaning, like, we can change lots of other things. If we don't change the rules of the game, if we don't change the policy environment in which business and the capital markets operate, we're likely not to have something that's meaningful and lasting. Each of those is insufficient alone. So the first era of B-Lab's work was not actually about trying to drive that kind of systems change at scale. It was really trying to build a model that we could look to. And so it was about building a credible community of leaders who could prove that model. It was about trying to get those leaders to take collective action on things like climate or inequality or racial inclusion. And it was about getting all of those businesses then to start to build power as advocates for structural change. So I think it's worked well for the last 13 years. There's a B Corp movement today that has over 3,000 companies. They're in 70 countries around the world, so it's a global movement. They represent every single industry, but they're united by one idea, that business can be used as a force for good. And increasingly, those companies are large multinationals with private equity or even public institutional capital. So I think we've successfully driven behavior and cultural change, but mostly by courageous leaders. And those courageous leaders have acted collectively to try to drive policy change, like creating new legal forms that make companies actually legally accountable to their stakeholders in 40 states and now in 4 countries around the world. And Prudential played a really critical role in catalyzing that work, but both through their investment fund, their social investment fund, and with philanthropy. But there's a lot of unfinished business. Changing the economic system means changing behavior and culture and structures at scale. And we haven't nearly done that. And so the next years are about that. It means ensuring that we have an inclusive economy, and that means racial equity. It's about engaging with multinationals. It's about driving collective action by businesses on the biggest challenges we face. It's about coalition building, because no one organization is going to lead a change in the way capitalism works. And finally, I would say it's about public policy. And all of those things are going to require significant infrastructure investments. And so, kind of like one of the Democratic candidates the other night, if you want to support that kind of work, you can go to www.bcorporation. No, I'm just kidding. So let me just talk briefly about like what's the opportunity right now, because the problem with systems change is it's going to take a generation, and there are a lot of things that have to happen that are going to take a long time. But the opportunity right now, I think, is that if we really want to take advantage of all of that fretting by billionaires, and all of the hand-wringing about the future of capitalism, and all the verbal commitments that we see from like the CEOs of the Business Roundtable, then it's up to all of us both to help them and to hold them accountable. And so some specific opportunities. The CEOs of the Business Roundtable and other public company leaders can go beyond a statement of intent. They can actually adopt stakeholder governance. They can actually make themselves legally accountable for considering those stakeholder interests, not just talking about purpose. And then they can manage and report their impact consistent with those legal accountabilities. In the capital markets, we talk a lot about short-termism and long-termism and maximization of value. The fact is that most investment fiduciaries are, in the end, investing on behalf of individual beneficiaries. And those people have a long-term interest not in the maximum financial performance of one company, but in the health of the market overall, in the resilience of the communities in which they live, and the quality and durability of their jobs. And so as fiduciaries, investment managers could actually act like that's the case. They can drive corporate behavior by considering social and environmental systems when they make their portfolio investment decisions. They can manage, they can actually engage with companies to get them to change their practices. And I think they can support CEOs who actually want to take on stakeholder governance. Like, they can actually endorse it, and they can go further than that. They can actually vote for it during proxy season. So there's a lot that they can do that goes beyond just talking about the fact that companies that they invest in need to have a purpose. And finally, public policy. The fact is, I think it's pretty hard to ask individual heroic CEOs to take a stand and change their behavior if there's not a level playing field. And it's equally hard to ask investment managers to consider a bunch of factors other than financial return if they're going to meet the fate of regulators or the market, if they're not going to allow them to do it. And so public policy matters, I think, in a big way. On March 9th, there are a number of people in this room who will be with us at the Ford Foundation to talk about how we create a long-term roadmap for policy changes that would actually enable businesses and investors in the capital markets to make their decisions based on the values that are value that's created for their stakeholders, not just their shareholders. So we've got to change the rules if we want to change the outcomes of the system we've got. So I just want to close by saying it's an amazing moment, right? There's a ton of energy. There's a lot of excitement about this idea of changing capitalism. And a lot of that conversation is happening in pretty elite spaces like this, but the pain and the vulnerability is mostly not in this room. And so it's important to keep those stakeholders in mind and work with them as we're making these kinds of decisions. This year, 2020, is the 50th anniversary of Milton Friedman's seminal essay in the New York Times. And in many ways, that's what we're talking about here, right? Like, what's actually the social responsibility of business or the social responsibility of the capital markets? And it's, I think, easy for lots of people to say that all we need to do is kind of like change the culture, and we'll have this pendulum swing from what Milton Friedman said to stakeholder capitalism. But I think it's a lot more deeply rooted than 50 years of Milton Friedman and culture shift. We're going to go tonight to the African American History and Culture Museum, and I'm pretty sure that we'll learn there that we have an economic system that was built not over the last 50 years, but over the last 400 years on human ownership, on appropriation of land, on exploitation of resources. And that seems to me like a system that is worth changing. Thanks very much.
That's great. Thank you, Andrew. That was fantastic. I'm going to be really short and sweet right now because the group up here is going to take its orders from that last piece of communication and start to take the mittens off and ground this work and the work of impact investing in community with real folks. And there's nobody better to lead this conversation than David Bank, editor, CEO, founder of Impact Alpha. Thank you, David.
Is this on? Can you hear me? I'm David Bank, and I'm the editor and CEO of Impact Alpha. And we have a 5-day-a-week morning newsletter covering impact investing that some of you might read. If you don't, you can have we have a special discount subscription code. I have to get that in or my team will skin me. So go to subscribe and use Aspen 50 and you'll get half off. We've given ourselves kind of this ridiculously audacious mandate of covering impact investing all the way from the smallest seed stage investments up to the biggest institutional investors across asset classes, stages, sectors, geographies. And so, needless to say, the people in this room have been immensely helpful in helping us navigate that, and not only as sources and contributors, but really as just teachers and mentors. And I was thinking all day today that these were the people that I actually learned from and have made us able to do that crazy thing that we try every day. When we started, we said we were going to cover impact investing as if it were a real beat, and in the expectation that it would become one, and it indeed has become one, as we've all heard today. Now the audience has expanded, and we're trying to get all over this bigger beat of new capitalism, or capitalism 2.0, or reimagined capitalism, or reinvented capitalism. It's kind of everywhere, isn't it? And so we're delighted to be here, and thank you to Aspen and Prudential for having us. We are all very lucky to have the panelists that we have here today as teachers and mentors for all of us. One of our operating assumptions had been that impact investing and impact practitioners have been living and developing this kind of new capitalism for decades. Kathy Clark talked about impact investing as kind of the R&D lab for this new capitalism. So we were charged with being the how panel. You heard the moral case earlier, you just heard the financial case. This is about the products, the practices, the performance. And the rest of the world wants to know what you've learned. So I'm going to ask each of you to share one big idea or key insight from your work that will animate this new capitalism. So the question is, what do early impact investors know that the broader financial markets need to know? So let's start, Tracy, with you. Tracy Palangine is the CEO of Social Finance, and I'll let you explain more, but just start with the big idea.
Well, thanks so much, David. And by the way, Impact Alpha is a great publication, online publication. Great to be with everyone, and thanks again to the Aspen Institute and Prudential. What an incredible milestone. And the animating thing that David wanted each of us to talk about, for us at Social Finance, as a 10-year-old impact investing firm, is the intense focus on outcomes, on results. And the way we think about that is to rethink and reallocate risk in service of that set of outcomes. You may have heard about our work around social impact bonds, and what I'm hoping to talk about today in the context of Capitalism 2.0 is thinking about how we achieve better outcomes in economic mobility in this rapidly changing future of work, shifting structures of our global economy, which has left a lot of people behind, what Wes and Dan and others have talked about this earlier this afternoon, and how we think about investing and funding human capital in the face of these massive changes. And very quickly, David, what has worked well in the 20th century is no longer working well. We all know that around the turn of the 20th century, massive expansion of public high school education has enabled a generation of broad-based economic growth and prosperity, and then the second half of the 20th century, basically going to college is a ticket to the middle class, a slingshot to economic mobility. And right now, we're no longer seeing that to be the case. Look at some facts, right? Like the Great Divergence, income inequality, the worst since the Great Depression. At the same time, we also have this unprecedented fast-growing economy, 50-year low in unemployment rate. In fact, an economist told me recently that we have never seen this in recorded history, that over the last 2 years, the number of unfilled job openings has consistently exceeded the number of unemployed. And there are massive number of factors. But the current system, or rather the 20th century system, places all the risk on the individual. So if you're a young person and you want to go get a good job via getting a college, you take on debt, accepting the full risk that you may end up with no degree and no employable skills, right? And wrestle with decades of debt going forward. Or if you're a working adult, you might have to put a pause on your paying job to try to get a credential, to get upskill, hoping to get up that economic ladder. but it may not pan out. And what we're trying to do, and hopefully we'll get a chance to talk about it, is how do you reallocate risk so that the individuals, especially low-income people, who do not have the capacity to bear that risk, especially in a more and more uncertain world, and how do we reallocate that risk across the public sector, for business, for employers, and importantly, for impact investors to make it work better for everyone.
So the reallocation of risk, you might have something to say about risk, Ellis. Ellis Carr is the CEO, President CEO of Capital Impact Partners. I was joking this morning with him that every time you use the acronym CDFI in print, you have to then spell it out because you don't want to assume people know it. So that says Community Development Financial Institution, which takes up a lot of space.
And as soon as you say that, they wake back up after you finish saying that.
But you know something about maybe mispriced risk or misperceived risk. But tell us how Capital Impact Partners is dealing with that.
Sure. So Capital Impact Partners, again, is a national nonprofit community development financial institution. And effectively what that means is we're a mission-driven financial intermediary. So we deal with capital and the allocation of capital. And I think for us, we've been working at the heart of this work, and others like us, for nearly 40 years, right? So there is a certain level of understanding that we have of the communities. And oftentimes we find ourselves really at the nexus of both community and quote unquote the efficiency, as I say, of the capital markets. And so oftentimes we see that there is misplaced risk, and there's additional risk premium put on things that are basically unknown, and typically that relates to disinvested communities. And we've been working at the nexus of this work for some time. I think for us, we are really thinking about how to kind of disrupt and redefine how capital flows in disinvested communities across the country. Really thinking about it from a few different frames. First and foremost, recognizing that people in communities are most proximate to not only the challenges, but also solutions, but they don't get paid for that, right? You think about the traditional capital markets equity analysts and those who are proximate to and understand certain sectors. There is a value that is placed on that. There is no value placed on people in communities, and we need to restore that. Secondarily, I think we need to think about, again, how community development financial institutions have been working at this work for about 40 years, but we've been really nipping at the edges of the traditional capital markets. And we need to think about how we put ourselves in the middle of the capital markets with structures and products so that we can then begin to influence and then change the way capital is assessed, risk is assessed, and capital can flow into communities.
So Deborah Schwartz, the managing director at the MacArthur Foundation, this all I know is very familiar to you because you've been one of my great teachers on sort of capital gaps and how to bridge them. So tell us a little bit about what you've learned in the context of your work at MacArthur.
Well, you just shared my insight, David. My insight after looking back.
That's what we do, is we take the best ideas and we push them out.
So just read it in Impact Alpha, you'll see. Let me add my thanks to our wonderful hosts from the Aspen Institute and Prudential. Prudential has been such an amazing colleague over the years to us in our impact investing work and in field building, and this is just really a fantastic gathering, so thank you. I do think that as we take stock of our own experience at the MacArthur Foundation over the last 40 years or so of impact investing, working with CDFIs, working with innovators in the social sector, our big takeaway is capital gaps are real. The market cannot actually solve every single thing. If that were true, we wouldn't have extreme poverty, we wouldn't have the inequality that we have, we wouldn't have the social problems and challenges that we face, whether that's in education or health or economic development. What we know, fortunately, is that market rate capital, profit maximizing capital, can play a fantastic role, can play a huge role. And Audrey can speak to some of the ways that they're helping harness that power. So we are not saying it's an either or kind of situation. It's a both and. We've got to have market rate capital that is increasingly impact oriented. But we also need what we call and others call catalytic capital to help pave the way, and whether that means investing in that early stage manager led by a person of color that's not proven out yet to let them get to the place where they have the track record and the scale to bring in the commercial capital, or whether that's providing a low-cost long-term loan that's actually pretty low risk and high impact to a CDFI. We need catalytic capital in all its forms, whether it's an all-catalytic approach or a blended capital, stack that is directly de-risking and leveraging. We need that too. We can't solve the problems that we face in the world today on the basis of an impact investing model that doesn't embrace the full spectrum of capital. And that's the good news, right? There is a spectrum of capital. It ranges from purely profit-seeking capital that doesn't care about impact one way or the other, all the way onto the other end with philanthropy, which is an incredibly powerful tool as well, where it cares about impact and doesn't need a financial return. And then there is everything that's in between. And I think our big challenge ahead of us is to figure out how more people can understand how to harness those different pieces of the capital spectrum. Everybody doesn't need to do everything, but we need to appreciate each other and have a vision of an impact investing market that brings all the tools to bear. And what I especially love about it is it's all about collaboration at the end of the day. That built into that model of saying, how can I use these different kinds of capital sequentially or collectively? It's all about figuring out how we leverage each other's strengths, each other's risk appetites, return requirements, and so forth.
Great. So we've heard risk and outcome orientation. We've heard revaluing community and proximity. We've heard catalytic capital and collaboration. Audrey, in our prep call, said she could play the role of somebody from the big world of big capital. So Audrey is the Chief Sustainability Officer and the Chief Marketing Officer of Morgan Stanley. I always like to say she's also a former Wall Street Journal reporter, as am I, so we have always had that in common. And Audrey, what have you learned in your I don't know exactly how many years, but of working on the sustainability side at a place like Morgan Stanley?
Yeah. So, thanks, David. We started actually working on sustainable investing 11 years ago. So if you think back to 2009, when there was kind of a lot going on in the financial services industry during the financial crisis, and starting kind of a new focus on sustainable investing was not the most intuitive thing, and certainly not what most people were demanding that we do. And I think that one of the things that for us was really important was that we really felt like it was important to recognize that sustainability, impact, sustainable finance, that it wasn't some sort of sideshow, right? It wasn't something that we were doing as part of our CSR efforts or part of our foundation or part of our, kind of sort of off to the lovely boutique side. We were actually saying, our theory of change was that thinking about environmental issues, thinking about community development issues was actually core to good business. And the challenge we really gave ourselves was, how can we prove out the case that you can harness the power of capital markets to actually help protect the environment and strengthen communities. We spent a lot of time working with wonderful partners. I've been saying this is sort of like old home week for us, but it's a wonderful reunion. And we have each of us have done various projects and initiatives together. And I think where we spend a lot of time thinking is, where would be the biggest differential impact that a large capital markets player like Morgan Stanley could play? And that while we loved being able to be a part of some catalytic transactions that had more blended return goals, that where we could bring the biggest contribution was, how do we get the whole rest of the capital markets to be able to do it? And so how can we find that area in the Venn diagram where profit maximizing capital could really align with impact? And how could we prove out the case that you actually can do both? So I would say in those first, the first number of years, and frankly still today, I spent a lot of my life actually just, researching and then sort of proselytizing around the fact that if you do the work and if you look at the numbers, you see that thinking about sustainability actually is good business, right? And that's part of how when we, we could go into the studies and whatnot, but I'll just, I'll give you the quickest data point is most recently we did a study of 15 years of performance, 11,000 mutual funds comparing sustainable strategies to traditional strategies, and we found that if you put the return curves on top of each other, they're basically indistinguishable. So there was no discount to returns for thinking about sustainability as a part of your investment strategy. Where you did see a difference, though, was actually in the volatility, that there was bigger downside volatility to the traditional strategies. So I've never yet met an investor who says, I don't want an investment that has the same return with less downside volatility. And as a result of that is how we've been able to do things like back in 2012, we actually started a product platform for our investors who, again, were just looking for profits and, and not able in many cases to think about concessionary rates of return or whatnot. And we said at the time, this is back in 2012, that we were going to have $10 billion worth of assets in those. And we got a lot of sort of like, did she say B or did you say M, right? Because impact investing is usually with M. And, we said 10 billion. We actually, within 5 years, we actually now we're over 30 billion. And, as I know you were about to say, that's a drop in the bucket of what we could get to eventually. And so that's why there's great potential. But I think that the biggest lesson for us is that something that I think everyone in this room sort of intuitively has always sort of hoped and known, but we've needed the data to prove it to capital markets investors, that if you take all of your best rigorous investment tools to think about investment, why wouldn't you also want the additional data that you get about both risks and opportunities if you think about environmental consequences, societal consequences, governance issues, and that all of those put together really is what we think about as truly sustainable business, sustainable both in terms of economic returns as well as actually in the impact.
We can get into later perhaps this notion, sometimes people think, impact investors are being asked to take uncompensated risks, but it sounds like you're saying that the non-impact investors are actually taking the uncompensated risks on the downside.
Yeah, I mean, I think it's one of the most traditional responses that we often get from traditional investors is to say, I don't want you to constrain my universe of possible investable choices by putting all these additional environmental and social stuff that's clouding my rigorous investment view. And I just say, look, if I told you that there's one portfolio that performs the way it performs, then there's another one that's the same and has a mystery element X added into it, and it kept returns and it decreased volatility, do you not want that one? And that really is just the additional insights from that. So we're seeing that really it's an important piece of actually evaluation and understanding not only long-term returns, which people often say, sure, but I'm interested in short-term, it actually impacts short-term results as well.
So I want to honor our pledge, our mandate to get into some examples and products. And I know, Audrey, let's just go maybe back the other way. Because you guys have put a lot of work into actually structuring products that you can offer, and you gave me a good example, and I don't want to, Deborah accused me of stealing her punchline here, so I want to let you let you offer your own example. But
sure. Well, I'll give two quick ones. One is more just sort of access to the products, and then one is a specific initiative that we focused on. If you think back 11 years ago when sort of all the impact investing conversation was first starting, a lot of times when people heard impact investing, their minds kind of intuitively thought of probably a pretty interesting, charismatic, probably private equity opportunity or some other kind of interesting concessionary rate. And you had to either be a mission-driven institution or philanthropy or an extremely high net worth individual to think about one of these things. We've been able over the years to be able to take it from something where you had to invest millions in it to, a number of years ago we did sort of only $400,000, $600,000 to get diversified portfolios looking at it. And more recently we've got it down to $10,000 and actually now $5,000 minimum investment where a traditional investor can actually align their investments with sustainability. The specific initiative, though, that we're really excited about right now that I've been spending a lot of my time on, and I think it's a great example of where you can take mission alignment, risk, and opportunity, and it becomes a really compelling investment thesis, is we've been focusing actually on plastic waste reduction. Last year, we as a firm actually made a pledge that Morgan Stanley is going to facilitate the prevention, reduction, and removal of 50 million tons of plastic waste from rivers, oceans, and landfills by 2030. And for us, it's something that we care an awful lot about, but it's also something that is really not just an environmental issue, it's an economic issue. Just to give you one of the many data points I could give you, every single year in single-use plastic packaging alone, we take about $100 billion worth of economic value and throw it away, usually after about an average of 12 minutes of use. And then it takes 20 years or more to disintegrate into microparticles that end up back in your water and your food and your salt. So that's a sort of economic travesty, if nothing else. Where I think it comes to business is Of course, philanthropy has a huge role to play here. Of course, governments can have a huge role to play here. And of course, consumer behavior has a huge role to play. But we need to facilitate a massive flow of capital to figure out how we actually re-engineer the entire economy, from how plastic is formulated in the lab, how it's put into products, how it comes into your home, how it's disposed of and recycled, and hopefully not ending up in your food and water supply. And to just give you an example of 2 products, the week that we announced it, we did sort of an initial proof of concept bond, $10 million with the World Bank, to help focus on marine health. Fast forward 6 months later, we're able to do a $1 billion green bond with Pepsi, where the majority of the proceeds were focused on reducing the virgin plastic in their beverage chain. And here's the financial kicker for the investors in the room. What was interesting was that this bond was so sought after because there was such a demand of investors wanting to have, high-grade paper, traditional debt that they understood how to risk rate and price from an issuer that they understood, and also aligned with their values, that it was highly oversubscribed, and it actually ended up saving Pepsi money to be issuing it as a values-aligned, plastic waste reduction-aligned, green-aligned bond, rather than just putting out regular paper in the market. So again, to your point, I think we're starting to see that there can be a real alignment of financial kind of dollars and cents, as well as impact.
We call those examples examples of
New capitalism?
No. Impact Alpha was what I was looking for.
I hear there's an offer if you put Aspen on your...
So self-serving, David.
Jeez. You gotta tee up those jokes better next time, David.
I didn't prep that one, obviously. Deborah, you at MacArthur, I know, is part of something called the Catalytic Capital Consortium, which is trying to put a wrapper, in some sense, around this whole notion that you've been discussing. So what's an example of a catalytic investment that makes the case?
Great, thank you, David. Yeah, so we launched an initiative last spring. Omidyar Network and the Rockefeller Foundation are our strategic partners, and there are many other investors and partners that we're excited to be working with to try to increase knowledge about catalytic capital, but also its use around the world. And part of why we're doing this is because we realize this is what we've been doing for 40 years. We just hadn't really thought about it as a practice. And what we realized, too, is that we need to help others because, as Audrey pointed out, it's not necessarily the easiest part of the impact investing spectrum to engage in, but it can be deeply meaningful and incredibly important. I'll just give you 3 quick examples, but I will also say that one thing we know is that examples of catalytic capital use abound. We invited proposals last spring from over 100 organizations around the globe. What it surfaced was over $2 billion of unmet need for catalytic capital, and that was $2 billion that could in turn leverage very significant sums of commercial investment if around the globe. So it's just 3 quick examples that I'll share from our own portfolio. One is from a portfolio focused on the Chicago region, and it's really an interesting contrast to the Pepsi example because they're both impact investment, but they're a world apart. So Pepsi is this big, well-heeled corporation with access to capital, doing something really wonderful and innovative in partnership with Morgan Stanley. We worked with a fledgling entrepreneur whose business is called Autonomy Works, and he had created a for-profit business, this entrepreneur, to provide meaningful employment and sustainable employment for young adults with autism, because his son is autistic. And one of the things was that when they aged out of school, they don't really have a place to go, and developmentally disabled sheltered workshops were not necessarily an appropriate solution. And in fact, he's built a business around the fact that his workforce, which is over 80% on the autism spectrum, that they are really excellent at certain kinds of tasks. And so they provide kind of back-end support and analytics for digital marketing campaigns. He could not get a loan from a bank for lots of reasons. Starting out, no collateral, a very unusual business model, wasn't really a business that was designed to say, let me do the thing that is absolutely profit maximizing. This business was set up to try to create these employment opportunities. And so we provided a loan using a structure called a revenue-based financing model, which is increasingly in use. And it was because it was an equity-like investment, and it was playing the role that equity would play in that organization, but it had a self-liquidating mechanism, because this is not a business that's going to go to IPO and have that type of liquidity event for the investor. So that's one example of kind of using really suitable financing for the enterprise. And that's a capital gap because it's a small, early-stage, innovative business. Other examples, very quickly, Terra Silva, which you wrote about, David, last fall, is a new fund that we've created out of the Catalytic Capital work. Packard Foundation is our partner. They're looking to build, through a blended fund that we've created together, really a whole new asset class around investing in sustainable land use in and near tropical forests, and the idea is to build up a whole cadre of successful fund managers. So it needs catalytic capital today, but the vision is that tomorrow these managers will be able to stand on their track records and go it alone. And finally, I want to mention the Zero Gap program, which has been pioneered by the Rockefeller Foundation through R&D grant making over a number of years. We co-invested with Rockefeller through a very innovative structure, and they are now managing a pool of funds and deploying it into businesses like SixUp, which is using an alternative credit scoring model to bring financing to college students that have been underserved, in investments in organizations like Craft, which is really working around the climate adaptation challenge, and many others. So we have some of these on our website, some are on the Rockefeller website, and we'll be happy to share any more examples that people are interested in.
Great. Tracy, you've always impressed me because of the sophistication and detailed work that goes into structuring the kinds of deals you put together, from social impact bonds and now the sort of evolution of that. So tell us about the newest evolution.
Yeah, well, it's wonderful to follow Deborah because it is Catalytic Capital that gave birth to the possibility of new vehicles like Social Impact Bond and what I'd love to talk a little bit about today, the Career Impact Bond, which is a new strategy. At Social Finance, we kind of, maybe we punish ourselves, but we invent these highly structured products with impact at the center of it. So the Social Impact Bond is about using private capital to make more effective use of public dollars, how government spends social spending, how they spend their social program dollars. And the Career Impact Bond is got a different twist. So instead of enabling government to pay for success, we're enabling low-income populations to finance their own success in the new economy. Over the years, we've actually touched, Deborah, it's great that you talked about all the capital along the spectrum, and we've been lucky to have experienced almost everything from R&D grant capital, and many thanks to the team at Prudential Foundation. It was a grant from Proofnet Foundation that enabled the birth of the Career Impact Bond. And then also over the years, we deployed Catalytic Capital in service of the social impact bonds because they are untested with no track record, uncompensated risk. Over time, we've been able to blend different structures to access the more commercial nature of it. And Prudential actually was in one of the social impact bond deals. And they just have been amazing at skillfully deploying capital along the spectrum. So how does a career impact bond work? Right now, we are actually working with the Pru team. We got introduced to a coding boot camp a couple of years ago by the name of General Assembly. First of all, I had never heard of a coding boot camp 2 years ago because they weren't really a thing until maybe 7 or 8 years ago because why? Our higher ed system is not responding to what employers need. Employers want digital literacy, and they are not giving these kind of worker-ready graduates. So a whole class of coding boot camps have flourished, and you've heard of many of them in the marketplace, and General Assembly is one of them. They have an amazing track record at job placement and sustained wages of folks who graduate going on a pathway of economic well-being. Yet their program is pretty expensive. It's not Pell eligible because it's not a Title IV institution. So it's $15,000, 3 months full-time. If you're low income and you have to pay rent and childcare and transportation, you can't take time off from work to take on this journey. Not least, they don't have the credit score or the savings to do this. So what we're developing with the Pru team and General Assembly is to devise an income share agreement model to enable low-income folks to access this high-quality training at no upfront cost to them and no risk to them. So the deal is that if you hit the eligibility criteria, which is defined as you've been in the criminal justice system, or you've been on public assistance, or you've been on EITC, then you can go into this program at no cost to you. And then if you're successful at getting a job that pays over a significant income threshold, then you pay a percentage of your gross wages over a fixed period of time with, importantly, a cap on the overall amount that you can pay. A lot of consumer safeguards. The ISA is the term of art, income share agreement, but because of the way we're thinking about it, which is the target population focus, which is, it's not just a consumer finance tool, you get a loan, you get an ISA, but rather, you can only access this if you qualify for it. And we're not just financing tuition, but importantly, the wraparound support services, which prevent many of these people from persisting and graduating. And finally, importantly, tapping Catalytic Capital to enable all of this to happen. So we're doing it in the coding world. We're also really exciting, working with Aspen and J&J, thinking about how the career impact bond structure could also address the labor shortages in nursing. It's actually quite timely to talk about this, but the WHO, well, they've had a busy season, but late last year declared that the year 2020 is going to be the year of the nurse and the midwife, because 2020 marks the 200th anniversary of the birth of Florence Nightingale, and professional nursing has really transformed patient care and delivered extraordinary health outcomes for large populations. But it's not easy to get up the nursing ladder. The average nurse graduates with $30,000 in debt, and of the 15 million healthcare job postings around the world, half of them are in nursing. So massive need, massive potential impact, and we're thinking about these innovative structures to enable that to happen.
Great. One of the undersung stories, I think, of recent years is how the CDFI world has moved into the more mainstream capital markets, and no better example of what you've done at Capital Impact Partners.
Thanks, David. Yeah, I mean, I think, as a mission-driven financial intermediary responding to the needs of the community, we have to be creative and we have to be flexible. We need flexible and creative catalytic capital to be able to respond. And so oftentimes, the birth and the growth of the CDFI industry was really fueled by the Community Reinvestment Act. And as we've recognized that we need new flexible forms of capital, we created a fixed income product to go out to the capital markets. Specifically, we created a S&P rated impact investor note that we issue every month, which looks a lot like corporate debt. So for individuals and institutions. So for as little as $1,000, someone can go into their brokerage account and buy a capital impact note. And that note is supporting affordable housing. It is supporting the creation of quality healthcare and education in underserved communities and addressing food deserts across the country. And we found that that has been a really interesting and highly successful event because we can pay a market rate return because we're S&P rated that has signaled to the capital markets what level of risk that capital impact is in this case, and we pay a rate in response to that. And what it does is it actually, the bigger part of this story, I think it's a success story, is we raised in probably just a little under 2 years over $150 million across a wide group of investors, both individuals and institutions, be it foundations, insurance companies, and socially motivated mutual funds. It's really been about the mindset shift and the conversation that we've had with individuals and institutions. So for example, they may call up and ask, so first of all, how do you make money, right? I didn't think you could do this work and actually make money, one. How do you think about education and what makes a good school? Why would you invest in a school versus another one? So we can talk to them about what a quality school is to us, and how do we think about restorative justice techniques within the school? And so that broker is not only working with a capital impact, but they're working with a wide variety of investors who they can take that education to and that lens into broader investments. So while we're a small little speck in the capital markets, we're beginning to really influence the purveyance of how people look at how they invest their money as well. The last thing I'll just mention too is just really the kind of the social activism of this, right? Having the ability to buy a note that aligns with your value with a little as investment as $1,000 is meaningful. So then it allows us all to have a voice to really be able to influence this new capitalism that we're talking about.
So I just want to tell folks to get your questions ready. I think we're going to have time for 2 questions, and we'll do it the same way as earlier, where we'll take the 2 questions and then we'll let the panel respond to both. Base financing for a full capital market. So $30 billion out of, I think, something like $2 trillion at Morgan Stanley, and not to put too fine a point on it, $1 billion from Prudential out of, I think, $1.5 trillion in assets there. And so the question really is, what next? How to, as everybody says, get to scale, as we've been talking today, not just capital scale, but impact at scale. And this is, you don't need to go in order here, just jump in.
I'll just go really quickly. I think that we are, from a capital markets perspective and sort of mainstream finance perspective, we are definitely in that moment of a massive sea change, right? And I think if anyone's read any of the papers in the past couple of months, you've seen things like, you know, BlackRock as the largest asset manager in the world with $7 trillion in assets, saying that they want all the companies to start thinking about sustainability disclosures. You've got State Street Advisors, third largest asset manager in the world, also saying that you recently at Davos, you know, was the year that a lot of CEOs came back and said, oh, that sustainability stuff was actually not in the side room for the breakouts after lunch or outside the perimeter, but actually on the main stage. Something new is happening here. And so I think we're actually seeing and you know, suddenly we're seeing lots and lots and lots of colleagues who have recently discovered that they have a long-standing commitment to sustainability, which is great. And so we're really excited about that. And for me, I think one of the most important things that we think about here is, so A, it's good news that the mainstream capital markets, mainstream investors, mainstream allocators of capital have woken up to the fact that for many, many reasons, in part investor demand, in part board demand, in part sort of social trends, and in part, you know, mega trends like climate change and income inequality and things that we are seeing can really have material impact on the economy. For all these reasons, they are seeing reasons to align capital with impact. I think the biggest thing that keeps me up at night is making sure that as we bring scale to this, that we're able to also really keep high rigor and quality. And I think that's something where everyone here has an enormous piece to play, right? Because this is one of those things where, you know, the great thing about Venn diagrams is you have an alignment of interest. The really challenging thing is it means there's 2 ways that you can mess up, right? So we as a movement can be in great peril a couple years from now if either one or both of the following things happen. A bunch of capital runs into sustainable investing saying, oh, I hear you can make just as much money and you can do good, and they happen to pick a couple of investments or funds or sectors or whatever that for reasons maybe completely unrelated to sustainability don't do well, and they say, see, we told you there was a reason that was, you know, all those mission-driven investors and, you know, people who've taken vows of poverty who do that kind of investing. We shouldn't have taken real capital there, right? We want to avoid that. So we need to be really rigorous about if you are making representations about return expectations, that those are really rigorous and diligenced as much as any financial product. On the other hand, if we're kind of loosey-goosey with impact, and we're like, yeah, this is a ESG, sustainability, equality, something good, fund, we need to be really rigorous about what does that mean, right? Are you saying that this particular fund is going sector agnostic and just choosing, you know, best in class in each particular sector, but not necessarily focusing on social impact, then that gives an investor understanding what that is. But it's very different than choosing one of the projects that you're working that's highly intentional around impact for students or impact for communities. And we just need to be so rigorous with ourselves, because the last thing we want is for investors to think that they were investing in one thing, to either have that impact go, you know, very awry, or realize only after the fact that they got an impact which was not what they thought at all. So I think there's a huge imperative on us that this is a tidal wave of opportunity that we are looking at right now, and we got to manage it really carefully on both the financial rigor and the impact rigor side.
Great. Let's get the questions and then work your answer into the general answer, because we're sort of running out of time. Is that okay, Aspen folks? So are there questions?
There's one way in the back.
I can't really see anything. If somebody's in the back, yeah. It was a good one.
Particularly for Deborah and the Catalytic Capital Fund, as you think about the restrictions around 501c3s and foundations that can sometimes make it challenging to work with organizations that are for-profit, not cash flow positive, when you think about private benefit or inurement laws, when you think about the role that family offices can play in dovetailing with the type of catalytic capital you're providing, what's your big ask for how someone like an Emerson or a CZI or any of the big, sophisticated, flexible, structured type family offices can play a role to amplify your work?
Thanks.
Is there one more? If there's not, we can just go, and I think nobody will complain. Okay, so let's just take that.
That's a fantastic question. I think one of the things that I'm really grateful for is that we have an amazing group of legal colleagues at the foundation. It is one of the real perks of being in a large private foundation, and I think they work incredibly well with us in trying to make sure that we can reach the kinds of organizations and intermediaries that need funds and work our way through some of the regulatory challenges. But there is no doubt that family offices and other kinds of entities have flexibility that they can bring to the table, and that's super important. Our ask for the family office community, the foundation community, but also the institutional investor community, the peers of institutions like Prudential, is to take their cue from a Prudential, for example, and think about whether or not in their impact investing work there's a way to include a piece of that might be a little bit more risk-taking, flexible, patient, a little more willing to be kind of that early problem-solving piece that creates the model, builds the institution, and paves the way for the more commercial capital down the road, or that, like we did with our colleagues at Citi, for example, where we built, and Morgan Stanley and some other banks, where we've been able to do blended structures together. And I think the bottom line is we have this spectrum of capital, and our hope for the field is that there's an embrace of the idea of a spectrum, that we don't land up with an impact investing field that thinks that everything can be ultimately fit into the market rate risk-adjusted model, because we know that if we do that, we're going to be leaving a lot of impact and a lot of innovation and a lot of inclusion behind. We are not saying it is an either-or, it's a both-and. And there was a fantastic series that our colleagues at Omidyar Network did last year called Beyond Trade-Offs. It features the Prudential model, but also 7 other family office and foundation and institutional models. And it's a great way for people to look at it and say there might be something there that's possible, that could be adapted or used. I would just say the one other thing, my one other closing thought was that we also have to remember, and I think we've heard this earlier today, it's not just about investing. And that might seem funny coming from the impact investing person, but it is also about the other pieces that are necessary for making change. That's technical assistance, research and development, research of other kinds, people and institutions, like we heard from Kathy Clark, and she is part of a whole community of folks that are really doing such important research to support the growth of the impact investing field. Impact measurement and management, and we heard about IMP from Kathy, and we think that is an important piece of infrastructure. Community engagement, finally, is also something that's critical to our work to make the impact responsive and authentic. And most of those things that I just listed require grant support. They can't be done through investments, and our investing work is not going to be transformational if we don't think about that larger ecosystem.
I was just going to add to your wonderful list of elements and the building blocks of a thriving ecosystem. And one more thing that I want to channel from our lunch conversation is the importance of smart policy and enabling legislative environment to actually do all these things. And I just want to call out, among others, the U.S. Impact Investing Alliance, friends here, has been really thinking about how to create this enabling policy environment, which is huge.
Ellis, you actually get the last word.
It's always problematic. Just to add on to kind of Deborah and Audrey's points, I think as we talked about today, there's been a continuum of capital that is needed. And as I started with this, right, it's all around kind of rethinking your role in it. And a lot of times we as organizations get really mired in replicating the things that we always have done in the past. But this is the time to really rethink that and really think about how you can add value within the continuum of capital role.
Well, great. I think you've gotten a taste of next generation finance, so join me in thanking the panel. Thank you all.
That's great. Thank you so much. Thanks so much. We're going to keep on rolling because, as you know, we're running a few minutes behind. So move around, swap cards for the cocktails later. And let me just take a moment to also thank everybody. We actually have about double the size of participation online right now, watching the live stream. So it's really exciting that there's a lot of participants around the country joining us today. I also want to call out that Twitter is busy right now with the hashtag New Capitalism, and if there's, you're going to want to remember that and fire back up your Twitter, because it's my privilege to introduce our next speaker, and it's going to be a wonderful conversation afterwards once we listen to Stephen DeBerry. He's a Henry Crown Fellow with the Aspen Institute, a managing partner of Bronze Investments, and he is here to talk to us about hacking, monopoly, justice, and joy. Stephen DeBerry.
I want to thank you all for having me. I want to touch on many of the issues that we've been talking about today from a little bit different vantage point. As she said, my framework here is really about hacking and monopoly and justice and joy. And when I say the word hacking, many of you probably conjure an image that looks something like this. Some kind of hooded technical person going after some kind of nefarious behavior. But when I think about hacking, I think of it a little bit differently. After spending a couple of decades in Silicon Valley, I have a broader conception of hacking. I think about using systems creatively to achieve what you want to achieve, regardless of what those systems are designed for. It's really about mastery of systems. And so I think monopoly is actually a useful metaphor for this. So I want to tell you a little story, true story, about playing Monopoly with my family, which changed my view. So I'm playing with my wife, my two daughters. This is, my youngest turned 10 yesterday, so this was probably 4 years ago or so. My younger was about 6, older one's around 7, and my wife. My younger daughter just learned to read. She's the least cognitively developed of the whole family. And so no surprise, by the time we got to the point in the game where everyone owns the property and it really starts getting into the good stuff, my younger daughter, Ella, is the first one to go out. She's bankrupt, and she's 6. So what does she do? She breaks down and starts crying, of course, right? Like this is, you know. And so I'm her dad. I'm saying, you know, like dad, I'm looking at my baby girl in complete abject terror and dejection. And so what do? I say, okay, Ella, take your properties and you come sit with daddy and we'll play together. Okay, so she comes and sits on my knee and we continue playing. We go on for another 10, 15 minutes, and lo and behold, the exact same thing happens with my next daughter. And she breaks out into tears and she starts crying. This feels awful. So I say to Cleo, my older daughter, okay, Cleo, take your properties, you come sit with daddy, we'll play together. So the unintended consequence of this is now it's daddy and Ella and Cleo against mommy. I definitely didn't plan for that. And when that happened, I had an epiphany. which is I realized that we were playing the game entirely wrong. We already owned all the property. And it was the three of us against mommy, and that's not fun, that's not joyful. And it occurred to me, why are we even doing this? I think we're playing the game the wrong way. And I said to my daughters, why are we playing against mommy when really we could be playing against the bank? And I realized, there's an opportunity to hack this game, hack the way we're playing the game. And it occurred to me, I could kind of see the math in my head when this happened. This is what I thought about. I saw a formula in my head. It's BB over P times V equals lots. BB is the bank balance sheet. P is the number of players in the game. V is the value per lap, which you know in Monopoly you get $200. And I realized if you just have this simple shift in perspective, you can actually hack the way you play the game Monopoly. And so lots is the number of laps it takes to own the whole bank. And so you can define with specificity how long it takes to own the whole thing. And the answer is, it's not that long. If you run that formula with the amount of money you have in any Monopoly game, with just a few players, it doesn't take long to solve the whole game and control the whole puzzle. To me, that's hacking, and the way we ought to think about hacking. And it's a metaphor for the way we could be thinking about impact investing, changing the whole system. And so I'm speaking in metaphor, but also reality, because a lot of the work that I've been doing for the past 2 decades has been focused on a different sort of hacking and a different game of Monopoly, a different field of play, which is largely focused on East Palo Alto, which is in the middle of Silicon Valley. And one of the peculiar things about East Palo Alto is it is divided by a freeway. Many of you have been there and will know what I'm talking about. Where on one side in Palo Alto there's extreme wealth, and on the east side of the freeway there is the opposite of that. In just about any way you measure it, whether it's access to grocery stores or water or schools or criminal justice activity or any number of things. And one of the things that I realized after years of working on this is that the scenario in East Palo Alto is not unique in any way. There are a host of cities that have this dynamic where the marginalized folks tend to be on the east side of communities. So here in DC, Southeast DC would be an example of that. And I see heads nodding in the crowd. I would ask you, if you can't imagine some community that you know of that's on the, quote, other side of the tracks, raise your hand. And no one raises their hand, right? You all understand what I'm talking about. This is just a smattering of the cities. The reality is if I listed them all, this entire map would be orange. And really what I was trying to do is just illustrate the point. And so I went with an early onset measles aesthetic. But you get the point that this happens everywhere, right? And the dynamic is actually at its core about some basic physical attributes of our Earth. The Earth spins counterclockwise. If you looked at the lateral aspect of this, what it looks like is the wind, and this is true in the northern and southern hemispheres. It's a little different around the equatorial regions, but as a general matter in the northern and southern hemispheres, the wind blows from the west to the east. And so the way to think about this is imagine we were all sitting in a giant circle around a campfire. The campfire is warm, and we all want to be warm, and so we need to be close to it. But the wind's blowing to the east. And so the question is, well, who sits with the smoke blowing in their face? And the answer to that riddle is people with less power. And that dynamic is playing out in all of those places that you imagined when I asked the question of whether you can imagine a community on the other side of the tracks. It's playing out everywhere across the US. It's also a global phenomenon. It's true on the east side of Paris and London and Vancouver and Jerusalem, Bombay, and on and on and on. It's a global phenomenon, again, in the northern and southern hemispheres. And this is a phenomenon that's been documented not just by me, but others around the world, including the Spatial Economics Research Center in the UK and other places. It's so deep that it's been embedded in our cultures. I mean, we already shared this. I said the other side of the tracks, and everyone knew what I was talking about. So I'm a linguistic anthropologist by training. I thought, well, where does that come from? And I pulled that thread and understood the etymology of it. It actually comes from this, which is trains, and the way that trains were architected to go into communities. And as a general matter, the wind, again, like the campfire metaphor, blowing particulate matter to the east, created the sense of the wrong side of the tracks. And so I've literally interviewed people who told me stories of their, grandparents who would go have to pull in the laundry from the clothesline based on the train schedule, because all the soot would mess up their clothes, and this is sort of the reality that led to this. What I know from talking about this also is that somebody is sitting out here thinking, well, what about the West Side? What about the Upper East Side in New York? And what I would say to that is, I'm trying to make a general point about disparity by design, right? So I was born on the south side of Chicago, which is not the east side by name, but if you were in the south side and you went any further east, you would be in Lake Michigan. The south side is actually the east side, but the west side of Chicago is also one of these marginalized communities. So the point that I'm making is less about a cardinal direction. The point that I'm making is if you go to a place and you get in a taxi and you ask the taxi driver, where are the poor folks? If they answer that question and point in any direction, that's what I'm talking about. What I'm talking about is the train tracks. I'm talking about the river. I'm talking about the freeway. I'm talking about the full complement of architectural affordances that divide the haves from the have-nots. And these are human design decisions. This is a picture from Brazil where you can see the abutment of wealth versus the antithesis of that. This is a picture of Menlo Park in California at the border of East Palo Alto, and you can see how sharp the distinction is. These are human, architectural, policy, economic design decisions that separate the haves from the have-nots. I came here to DC from Montgomery, Alabama yesterday, where I recently spent a bunch of time studying the history of slavery and the related economics and the laws associated with that, visiting the lynching memorial and museum there. And it's crystal clear that in this country, we have never really tried the experiment of designing communities that work for everyone. The history of this country is one of having a first principle of design that there will be haves and there will be have-nots. That has been the design framework that we have worked with, and it's something that we can get away from in this moment. That approach, those first principles of have and have-nots have pervaded all aspects of our society, including and especially the way that we manage our financial system. So these are maps, these are redlining maps, which our federal government supported and sanctioned. These maps told banks where they should not lend. And if you notice the red, which is sort of the no-lend zone, which is why they call it redlining, tends to be clustered on the east sides of these cities. And it's just one example of the perverse design that we've used to structure our financial systems. And it's a design behavior that we continue to this day. And I won't go into all the perversities that I saw and think about from Montgomery, but I think about some of the policy frameworks that are in play today. So for example, opportunity zones, which are significantly targeted towards these East Side communities. But I also think about the rules of the game. How are we playing Monopoly? What needs to be hacked? And I think about the fact that it's not possible to participate in investing in opportunity zones unless you have wealth that was created from already having wealth. That's a broken design. That's something that needs to be hacked and worked around. In aggregate, when we look at the complement of our history and the range of policies and laws and behaviors and investments, I think this is what we've been doing. We've been rudely blowing smoke in the faces of folks in marginalized communities and then continuing to marginalize them. So I go back to that hacking metaphor and I think about how we use design, how we have different first principles to approach these problems. And so let's go back to that campfire metaphor and I think, well, how would you play that differently? A simple way to do that would be just sit in a horseshoe. So simple. It's like playing Monopoly with the kids and saying like, hey, you guys, let's actually play against the bank. And you realize with just a simple shift in perspective, you can radically change systems, right? So 2 points about this. One, which I've said before, I'm speaking in metaphor, but I want to be explicit. The point of this is not to say that you get to go into East Side communities and just move people out of the way. That's absolutely not the point. And I think the opposite is true. And desperately needed, particularly in this moment that we're in this country, which is one of the greatest things we can do right now, one of the most powerful things we can do right now is get a little closer to each other, actually make space, and that's a powerful move. So I go back and I think about these divisions that mark not just East Palo Alto, but East Side communities in general. And as a general matter, as I said, this is about disparity by design, but I think there's an opportunity to translate that into prosperity by design. And I think that's the work of impact investing. That's the work of our community as a collective. So I want to give just one example from the bronze portfolio of what that looks like in reality. So I show this picture of a plate and a knife and fork. And that is a reminder to me that if I were to take you as my guest today in East Palo Alto, there are only 2 places to eat with a metal knife and fork. One is on the west side of the freeway, which isn't broadly regarded as East Palo Alto, but it technically is, inside the Four Seasons Hotel. The only other place to eat with a knife and fork is in the IKEA cafeteria up on the 2nd floor. Other than that, your dining options are Pizza Hut, McDonald's, Taco Bell, etc. It's a food desert. And one of the consequences of that, besides being inconvenient and making it difficult for me as a father to teach my children how to design, how to dine, is that the community radically over-indexes for diabetes because the food is laden with, it's nutritionally poor. So we think about type 2 diabetes, which is, a terrible disease. The reversal rate for diabetes is 0.4%. So around that, it's 0. Like you can't reverse diabetes. What the usual suspects in the medical establishment will tell you is you can manage it. You can take some drugs and we can try to control it, but it's not regarded broadly as a condition that you can resolve. We're spending in the US right now over $400 billion every year to manage type 2 diabetes, not reverse it. We've got an investment in our portfolio, a company called Virta. And what Virta does is they use a technology that can be delivered over your phone and some diet and behavior, and basically it's a medical clinic in your phone that has generated a reversal rate of 60%. So 60% reversal versus 0.4%. And I'm saying reversal, not management. The company's goal is to reverse type 2 diabetes in 100 million people by 2025. And they're well on the way to that. And the attendant economics are quite attractive. And I think this is an example of the kind of investment that we get really excited about. My view of, I mean, there are lots of definitions of impact. My view of impact is an incremental unit of revenue drives an incremental unit of impact, and vice versa. So every time we sell treat another person with the Verta program and reverse their diabetes, it's driving revenue and profitability for the company, and vice versa. That's the ideal state that we want to be investing in. And so I think at the end of the day, we have an opportunity to pursue justice, which is a cousin to hope. I think about where we are with this East Side work, and part of what gives me hope is that after years of work, people are starting to understand the injustice of the frameworks that we've been trying to fight against and redesign. We've built an East Side Alliance, and people are starting to really get behind our work. Certainly the Aspen Institute and Prudential, who has invested in us, and the Aspen Institute, where I've been a fellow for, a decade and a half. And I'm grateful for their support and continued support. Universities, certainly companies, and community activists are getting behind us in this East Side movement. And I'm particularly grateful that it's starting to turn into a movement, and we're seeing evidence of that. The beginning of it last year, around graduation time, I got an email from a friend, and she said, I'm at the University of Pennsylvania, the UPenn graduation, and the graduation speaker is talking about East Side stuff. I had no idea. 2 weeks ago, I got a text message from the guy who runs environment work for Mayor Garcetti in Los Angeles, and he sent a little film clip of a graduation ceremony for an incubator that they're running down there. And he said, we've been using your East Side talk as part of our education program here, and this is the graduation speech, and they're talking about East Side. And that is important to me because it is a marker that we're moving from just investment work to movement work. And that suggests to me that we can start getting this to scale. And the other thing that really encourages me is, especially coming from Silicon Valley, the understanding and appreciation that we have a remarkably impressive arsenal of technologies to point at these problems that we're trying to solve. And not only do we have these technologies to point at these problems, but the technologies are getting better and greater in number over time. We have more capabilities to attack the problems and work the puzzles that we're trying to solve in Q1 2020 than we did in Q4 2019. It is moving that fast, and we will have even more in Q2. And so our capabilities are better and better, literally month after month. And so what that suggests to me is the ability to not be incremental about the way we think about this work, to radically imagine what's possible and know that it's not just play and it's not just imagination, but that we actually have the potential today, right now, to solve some of the most intractable problems that face our communities. And that potential gives me, and I hope you, great joy. Thank you.
Oh my God, that was so great. That was Stephen DeBerry, and East Side is a TED Talk. You can watch it on YouTube. It's a great one, and I think you'll agree with me as I get out of the way very quickly that discussion sets up this particular panel beautifully. To lead us forward, Ruben Teague, Vice President for Impact and Responsible Investments at Prudential. Ruben.
Thank you, everybody. I would like to start this panel with an agreement with the audience. I will offer you something in exchange for something. In exchange for not running out of the room, would you like to stand up and stretch for a moment and then sit back down? You've all been sitting for a little while. Yes? Those who want to, those who do not wish to may stay seated, stretch. I'm not going to lead you in any kind of stretching exercise. Feel free to pick your favorite movements, twist, reach. All right, now back down, be quiet. Thank you. That's enough. That's enough. I didn't say it was going to be a long break any longer, and some of you clearly would have run away. This panel, I think, was set up really, really nicely by Stephen's talk and by the conversations that have come before about the what and the how. And here we are talking about the where. I want to apologize in advance because the prior two panels were led by professional journalists. And when I put my hand up to do a panel, I did not realize that that would be the case. So from Kimberly's, perfectly timed, probing follow-up question and David's encyclopedic knowledge of the industry, you kind of get a little more of a, an inclusive, homegrown feel here from me. But this is something that really matters to me, and hopefully that'll come through. And we've got an amazing panel here of people to talk about doing place-based work. And I'll intro very briefly. Why does place work matter to Prudential? You've heard some about that, and those of you who know something about Prudential know that our history in Newark is really core to the way that the company sees itself and the way that the Impact Investments Group has always seen what we do. As a firm, we've put well over $1 billion into the city of Newark. We've invested in its schools, we've invested in jobs, we've invested in housing, both affordable and market rate. We've invested in its parks. We have really done everything we could as a firm to try to both catalyze economic opportunity through growth and make sure that those most likely to be left out and most historically left out could be included in that. Newark had its peak population in 1930 at close to 450,000 people, and that declined to about 270,000 people by 2000. The 20th century for Newark, like a lot of other cities, was a period of segregation and white flight and intentionally discriminatory economic policies that really left a lot of the citizens there behind. Through it all, Prudential remained, and through our work, what we're trying to do is help the city see a different future, a future that feels better, that brings more people to the table, and that undoes some of the harms of the past. And that's why we wanted to have a panel here to talk to three experts and three people whose work and passion for place really has led what they do professionally. And so I'm going to just jump right in here. Jim, I'll start with you. Jim Shelton is the Chief Investment and Impact Officer at Blue Meridian, which is doing a lot of different things, but one of the things that they're doing is pursuing a regional investment strategy, a regionally focused investment strategy. And Jim, could you just talk about why an organization would care to do that, why it would choose to use its resources in that way, focused in some very specific targeted places?
Sure. I mean, the reality is that our broad aspiration is to improve economic and social mobility nationally. But if you just take some certain things into consideration, you don't really have a choice if you want to see that happen, but to focus locally. Everyone by now is very familiar with Raj Chetty's data that shows what has happened with mobility over the last half century, where the likelihood of actually doing better than your parents, basically the American dream, has dropped from over 90% to about a 50-50 chance in the 1980s, looking like it's still on the decline. That opportunity is actually not only differentiated by region, but it's differentiated at the hyper-local neighborhood level. So you can look at a city map and see differences in mobility from one neighborhood to the next. This is not any surprise to anyone who actually has lived in an underserved neighborhood, but the reality is that our strategies have not recognized this and how you actually create opportunity. Now, there are two ways that you create opportunity. One is by actually investing in the kinds of pathways and opportunities that people need to improve individually. The second is that the biggest thing that determines your actual chances of being upwardly movable are where you live and who your parents are. Now, I'll translate that into your context. And so if you want to see people be upwardly mobile, you have to not only invest in them, you have to invest in their context. And the way you do that in a systematic way is locally. And I'll just say one more thing and then I'll be quiet. There's a bunch of different research that talks about how you actually get people, especially people who have been in poverty, to be able to escape poverty. And it basically says 20 years without a mistake, right? Get it right, even though you're poor, in terms of going to school and being ready, in terms of getting a third grade and being able to read, et cetera, et cetera, et cetera. And the only way that that is likely to happen is if you can get a set of supports and their family and everything lined up in a way that you can compound the benefits of the good thing that happened before. So it doesn't matter. Actually, let me just really quickly. How many of you are parents? Okay, how many of you thought if you got nailed preschool, you were done? Right? But like, we talk about like Head Start, oh my God, it has fade out effects. All that means is, if you go to a great preschool and then you go to a sucky elementary school, it doesn't stick around, right? So you have to be able to compound those benefits over and over again, which means you have to align them in people's neighborhoods and the places where they live. And things like access to housing, access to stores, as Steve talked about, access to food matter. Now, all this sounds like so much common sense, but for some reason, when we organize our resources and our strategies, we want to pretend like individual interventions are enough. And they're just not. So Einstein had a quote, it was, everything should be made as simple as it can be, but no simpler. And my position today is, one of the reasons to focus locally is, it is necessarily complex to try and solve the problem of poverty and mobility. And the only way you're going to be able to do that well is to do it locally.
Okay, I just want to follow up there. You know, when you think about all the different potential investment strategies that you've got to invest locally, do you have a hierarchy? Are there strategies or systems that you would pick first to put that first dollar to or that next dollar to in terms of ROI for those outcomes?
So the reality is that it's highly contextual because it depends on where the needs are and where the assets and the momentum actually exist today. So the first thing to recognize is twofold. One is that if people have managed to navigate their way through the systems to the point where they can actually achieve some post-secondary education and a meaningful job, the likelihood that those people will then be able to support their kids is extremely high. And so though the returns in I'll call it economic senses, in investing in early childhood are very high, the ability to actually quickly have an impact on multiple generations is at the other end of the spectrum where you invest in people to get jobs, and then they can invest in their children. That said, the reality is that the compounding effects of, for example, unplanned pregnancy are multi-generational. A child born to especially a low-income, but not exclusively a low-income parent in an unplanned way, that child has a higher likelihood of being low income for the rest of their lives, and it reduces the likelihood that that parent will ever escape as well. You look at communities like the state of Delaware, which has been able to dramatically reduce that in a matter of years. That's also another leverage point, and a scary one for some people.
Thank you. Andrea, I want to turn to you, the executive director of Propeller in New Orleans, and I want to ask you about, you know, your work sort of started locally. It is based in a specific place, and you've kind of adjusted your lens over time in terms of how you do the work to have a more explicit racial equity focus, which I think is an interesting and important lens to add, and particularly in a city like New Orleans. And I'd love for you to just talk a little bit about why you made that shift and how it fits in with your work and how those two kind of layers of geography and race intersect.
So I would say that racial equity is the work, and racial justice is the impact that we all are trying to make. And so it goes a lot with what Stephen was saying earlier about the design of the system. Well, my position is that when we look at disparities across every single system, and I don't think people would really argue too much about this, whether you're looking at health, early childhood education, housing, economic mobility, we find the same disparities across every single system, and I challenge anybody to give me one system where that is not the case.
where we break, everything is breaking down along racial lines, with whites at the top, Asians and Hispanics as a buffer class, and African Americans at the bottom. And so we see that replicated across all the different systems. And when we talk about impact and impact investing, what are we not talking about if not addressing these disparities? And at the core of all of it, what we talk about really is that structural racism is in the groundwater that is feeding every single system. And so to have an incubator that is focused on social innovation, that is focused on addressing health disparities, education disparities, really, when we get to the root of it, it's structural racism. And so if we don't have a strong racial equity lens to our work, we're actually working against ourselves. And going back to Jim's point about how all of these factors are intersecting, and going to your question, Ruben, about like which one would you choose first? Well, the issue is that they're all a manifestation of the same thing, which is structural racism. And so when we put up, the choices that we often make in impact investing or philanthropy, where it's like choose this or choose that, well, really, that's, in my opinion, it's a little bit of a false choice, because really the thing that we're addressing at the core is the same thing across every single system. So that goes to the why. And then in terms of my work is in entrepreneurship, obviously. We run an incubator, we have accelerator programs, we have a fund, we have a co-working space. And going back to what Stephen was talking about, the design of these systems, I think the other part that's really important to acknowledge is that where we are now, there's so much history that has been part of the design to get to where we are now today. And a lot of the policies, a lot of the speakers were talking about the need for public policy. Well, a lot of the policies were put in place, and many of them seemed race neutral on the surface. So we can talk about the GI Bill, we can talk about Social Security, but they were racially exclusionary. And so even things that seem racially neutral on the face actually are not. And those impacts are being felt right now when we talk about the disparities in design of our capital system. Well, people of color in this country are thousands and thousands of dollars behind their white counterparts because of the policies that have been set up in the country. And so I'll just give one quick example of Social Security. So it was an intentional exclusion of domestics and farm workers, and that essentially left out about 80% of the African American population in the South who could not benefit from Social Security. So when you have that compounded over time, Stephen also talked about the monopoly game. Well, you've got people, communities of color that are starting years and years behind, and so how is that just, and how are we now addressing the bias that exists in the systems, because racial bias still exists in our current investing systems, and we know that. And also, how do we address our the past privileges that were not distributed evenly?
Thank you. And just as a follow-on, do you feel like, explicitly addressing structural racism through your work and thinking about investment work with that lens, is that a thing that everyone in your sort of world and in the impact investment world that you talk to has gravitated to and been comfortable with, or have you had to have some difficult conversations to get to that point?
We laugh because anyways. So I think that people are starting to gravitate towards that, and I think that is a really positive thing. And I don't know that there is enough acknowledgement of the historical, historical context. Because when we look at the way things are now, we tend to go to, oh, well, why is this community impoverished? Why aren't people just need more training to get access to capital, more whatever, right? And yes, that's true, and we have to acknowledge the historical context. And so difficult conversations with people, yes. And
I don't get the sense you're afraid to have those difficult conversations. If anyone wants a difficult conversation, Andrew will be available after. So Rodney, turning to you, speaking of critiques of the impact space, you've done a lot of writing and thinking about what impact investment is and isn't doing, and have expressed, a concern that we might be replicating some of the historic mistakes of capitalism in the past. And that's been discussed a little bit on the stage today. And I would love to hear kind of what you think can be done at the local level and why that's an important scale to not make those mistakes. Why is that the right place to go when you want to design or build capital structures or investment opportunities that can avoid falling down that same path?
So first of all, you made the mistake of having Stephen before us and then pairing me up with Andrea. So
I've made so many mistakes, I can't.
So one thing I want to acknowledge too, for the first question you asked actually to Jim about the importance of local, particularly within the context that Andrea just pointed out in terms of where we are racially, right? And the conversations we're having. So at least in the US, when you think about this, by 2040, 2041 or what have you, we're going to be majority people of color. And actually, if you look at many of the communities, like for example, New Orleans, Baltimore, my hometown, Oakland, where I live today, those places actually look like what our country will look like moving forward. And so many of the sort of economic challenges in a number of systems that are interrelated, to Andrea's point, these communities are places where, for those of us who are looking at the national impact that Jim was talking about, you really have to reconcile what's happening locally, right? You have to see it because, quite frankly, with the country moving that direction, that might be the place, these communities and these leaders who are doing remarkable things, that's actually where we might be able to find some hope, right? And some clarity. In terms of the question around impact investing and this broader critique that I myself might offer, we're even in the conversation, we're talking about new capitalism, we're talking about impact, we're talking about innovation, and we're talking about inclusion. And so the questions I always ask are, what are we actually doing differently, right? So Stephen talked about systems change, and we've talked a lot today about like strategies and tools and vehicles. But actually, for example, when we were citing sort of like market fundamentalism earlier and sort of like the decades focus around that, there was a foundation of sort of thought. There was a foundation of like narrative shift that occurred at the same time. And so one of the things I think about in terms of impact investing is how much over and over. One wonderful question asked earlier from the first panel in terms of, what's the willingness, for example, to maybe accept less for impact investing. If you can actually drive equity, you can actually have impact. I can't say the inverse is true, right? You can have we had the conversation about short-term and long-term, for example. And so if you have that sort of focus on short-term impact, you might achieve it. But are you going to have the longer-term goals of actually driving equity? If you focus on equity, you actually will have positive impact. And so those are some of the things I think about. And then when we look at some of the remarkable things, obviously the work that Andrea is doing is an example of this work. But I think about some of the things, just up the road in Boston, for example, like the Boston Impact Initiative, which is doing really remarkable work in terms of focusing in on the racial divide and wealth in Boston, in which the median wealth for African Americans is $8, right? Supreme racial disparities in wealth. And so you have to ask yourself, can you both reconcile with the historical and contemporary? We talked about redlining earlier, it's still happening today. It's not just in the past, it's happening right now, right? Can you reconcile with that level of exploitation, right? All these sort of things, and also optimize your return on investment at the same time. Because it seems like you're actually going to perpetuate the dynamic, right? So when Stephen was talking about opportunity zones, typically folks who are making impact investments already have wealth. So on one hand, you might be increasing your wealth, while at the same time trying to actually reconcile wealth inequality, right? And so it's sort of like this cognitive dissonance. And so these are kind of questions that we think about. And so looking at what you can do locally with the Boston Impact Initiative, for example, where you're fixated on a place, all right? And when Stephen's talking about systems change, you actually shrink down. Deborah Fries, who founded Boston Impact Initiative, talks about this a lot. You can shrink down the systems that you're working on, these interdependent systems, and actually focus on a community that can then sort of deconstruct all of the challenges that are happening, leveraging opportunities for investment to be catalytic in terms of who owns and who has decision-making power.
In terms of, and just as a question for anyone on the panel who wants to pick it up, in terms of designing those approaches and thinking about local problems and then developing local solutions, are we doing a good enough job, and how can we do a better job, maybe, I'll answer my own question, bringing more voices to the table? What are some examples of that you've seen in your work, or places where you feel like we could be doing more to get more people involved in figuring out these solutions?
Well, just really quickly, I think part of it is when we talk about, and that's the difference to me between inclusion and equity, right? So I'm going to go back to Boston, think about our friend Aaron Tanaka and the work Boston Ujima Project. They're building their own table to bring others in. And by what I mean by that is a focus on local residents who have an opportunity to come together to think about where investment should go. And so investing in themselves and attracting other investors into it, but actually creating the container for them to actually have decision-making and not being invited by someone else, but actually creating that context for themselves.
I'll just throw in, I think, no, we're not doing a good enough job. And I think, I just quickly, three quick things. One is, in this audience, I think broadly we just need to recognize, we've talked a lot about compounding today. And so one of the challenges that we're going to have to wrestle with is, we all know that when you're trying to convince somebody to save, starting earlier is better. But what if somebody started 2 generations ago? Right? And so the question is, can you actually design a system that catches up and disrupts compounding math that is that extreme? The second question is, if you're going to disrupt it, you need to actually create something that doesn't exist today. And one of the things that is true is that what we've learned a lot about is human-centered design, that you design solutions around the needs of the people that you're trying to serve, and that their perspectives are the only way you're going to actually create something that's going to change fundamentally the way the job gets done. We don't do a good job of that. Most of the dollars that flow through traditional channels that look at traditional criteria and don't create the space for the kind of innovation that needs to happen to create truly radical solutions. Part of that is because we don't actually have the mechanisms to push the capital down to folks who actually need it in ways that we respect. Not that they don't exist, in ways that we respect. And so you have to take the leap of investing through channels that are proximate to the people who are going to come up with the solutions. And we haven't come up with a way to do that yet that we collectively, well, I'll call it validate. The last thing I'll say is that the pathway, the broken capital markets from local entrepreneurs who are solving local community problems to become scaled enterprises are broken as well. And so unless we actually start to think across the capital spectrum, not just about it came up earlier, not just about the types of concessionary capital, which we actually need to kill that word because there's real value in the impact that gets created. But we need to also think about how we bridge people to the different stages with folks who are prepared to recognize the value they're creating.
One of the things that comes up a lot in the impact space is measurement and metrics and what we're doing. And I think, at the local level, my question is, what should we be measuring? We don't have a lot of great examples of cities or locations in the United States that I think everyone would agree function equitably. In fact, in our greatest wealth generating locations are also some of our least equitable locations. What should we take away as our North Star and be looking to as a that driving metric that we ought to be trying to move towards? Or am I oversimplifying the problem, and should we not speak in that language anymore? And if not, what should replace it?
I think measurement can be very useful, and I know that this is not going to solve the problem, but I think at a minimum, if we could get rid of the racial bias that currently exists in lending, that would make a huge difference. So I don't know if you can call that impact, but to me, that's huge impact, just by taking out racial bias. And that's nothing about concessionary or what, that's just fair is fair. You know, when you're looking at someone on every like creditworthiness measure, that everyone gets a level playing field, just on that across. So if you're gonna measure the health of the community and its you know, capital and people's access to capital, just take out racial bias would be one.
So the U.S. Partnership for Mobility came up with the framework. It actually is pretty broad. I would just point people towards it since we got a minute left. What I would say is that it doesn't actually take into consideration wealth creation. And the other thing that we actually need to do that actually came up in this conversation is we have to plan for inclusive growth, both community-wise and individually. And what I mean by that is that, take the Opportunity Zone example, the way it is structured today, it will draw in capital without a design for how you actually let the current residents benefit going forward. And that's been, frankly, the history of low-income housing development in this country. The only way that happens is outside of the capital structure, there's a deliberate planning process that probably is a 2-decade-long plan for how you actually build communities that are highly integrated economically and deal with the fact that you're going to have to create both economic and political incentives to do that.
So,
you want the last word here, Ron?
Well, I'm sorry for that, but so one last thing I would say, and it just goes back to what Jim pointed out. Excellent question, right? And what are the opportunities to actually ensure that those of us here are not actually always determining what the metrics are, right? So how do we ensure that there's a human-centered design? Are you including for individuals who are directly impacted, communities that are directly impacted? Because again, I think that could be sort of a little bait and switch, or sort of a perpetuation in which investor class institutions that have much more privilege are actually creating the metrics and terms for what success looks like. So just want to make sure that this is an opportunity in which we can actually include folks that are actually directly impacted to kind of come up with those metrics.
All right, I think that's a great place to end. Please join me in thanking these fantastic panelists.
How is that for mystery? I love it. We are almost there. You guys, if you're looking at your watches, don't bother. This is we saved the best for last. This is an amazing, energizing power panel. We're going to bring it all together, and I am introducing Peggy Clark from the Aspen Institute, Vice President and Head of Global Innovators Group, to kick it off. Thank you, Peggy.
Stage takeover. Did you guys get that? We're saving the best for last. And this is a panel of barrier breakers. This is a panel of superwomen. If we had the time to learn about what each of these women have done, you would just be amazed. But the superwoman pose completely works with this group, and so I'm really honored to have you guys here. So I want to just start by asking you to introduce yourselves. Can we start with you, Marla, briefly?
Hi, I'm happy to be here. I'm Marla Blow. I am a Senior Vice President at MasterCard in the Center for Inclusive Growth, where I run our social impact policy and work on all aspects of financial inclusion, economic inclusion, strategically across the United States and Canada for MasterCard. I come at this after having spent 5 years as an entrepreneur, where I built a credit card company offering credit to underserved consumers, and sold that at the end of 2018. Before that, I helped start a government agency called the Consumer Financial Protection Bureau with a then little-known person named Elizabeth Warren, now much more widely known. And before that, I was an executive at Capital One. So I've spent my career looking at these questions about financial inclusion and economic access from the lens of corporate, from the lens of regulation, from the lens of an entrepreneur, and now getting to look at it from the perspective of philanthropy. So really excited to be here, really excited to be in this fantastic partnership with the Aspen Institute. I should also add I am a fellow in the Aspen Institute, and I'm a member of the Aspen Global Leadership Network as well.
Thank you, Monica. Superwoman, right? I told you. Monica, please.
Thank you, Peggy. So my name is Monica Mantilla. I'm the managing partner with Small Business Community Capital. We're an SBIC impact private equity and private debt fund. And I'm also the CEO of Altura Capital. The work that we do is very simple. We help entrepreneurs to grow, and we provide them the capital and the strategic resources so they can achieve scale. I also have the great privilege and honor of working with a number of Hispanic organizations and diversity organizations. I chair the United States Hispanic Chamber of Commerce Foundation. I'm in the board of the Stanford Latino Entrepreneurship Initiative, and the board of the Hispanic Heritage Foundation. And all of these are wonderful organizations that are the ecosystem of people and organizations that really want to take the Hispanic community to the next level and integrate it and convert it into the mainstream conversation, not a segmented conversation, but a mainstream conversation. I've also had the great honor and privilege of being part of Aspen Latinos in Society, which has been a phenomenal program led by my friend here, Abigail Golden Vasquez, and it's a wonderful group of people that we've developed playbooks and a lot of things that are putting us into action and propelling us with wonderful ideas. So thank you to the Aspen Institute, and thank you to Prudential and your wonderful work. Congratulations on achieving the 1 billion mark, and to Lata and Ruben and Tony and everyone in the organization that is doing such phenomenal work. Thank you for your partnership.
Thank you, Monica. That's beautiful.
Ulili, would you introduce yourself?
Sure. Good afternoon, everyone. My name is Ulili Novatpuri. I'm a partner at Capitol Capital. We're a seed stage impact fund based in Oakland, California. Our thesis is to close gaps of access and our opportunity for low-income communities and our communities of color. And we primarily invest in tech companies in the early stage, so we're usually the first institutional capital in at the pre-seed stage or the seed stage. And we work with them in addition to funding their companies, but also to build inclusive teams. And I'm excited to be here, and it sounds like I need to become a part of the Aspen Institute, so let me know how to sign up for that. And since Prudential, you have all this money, we have 136 companies who are always looking for funding, so I want to put that out there as well.
Beautiful, thank you, Lily. Let me say that in reading about these three remarkable women, there was a common theme and a quote that actually each of them said, which is the same things. But first I want to tell you how unusual this group is. It's less than 3% of venture capital goes towards women-owned businesses, and less than 7% of venture capital funds are managed by women. And so you're looking at a group of fighters here who've been at it for quite some time. But in their writings, all of them talked about, and I want to ask you to jump right into this question. You talked about the problem of being in the diversity bucket, that you're over there on the side, you're doing the diversity work. What does that look like? What does that mean? And what are you doing to change it? Marla, you want to start?
Sure, yeah, happy to. So I guess the key way I think about that is there's a gigantic pie of capital that's available, and perhaps there's a slice of it available to all of diversity, theoretically, whatever that might mean, including women, like somehow women are a niche, right? And women's like 51% of the population, not a niche.
Did you all hear that? Women are not a niche, okay?
Women are not a niche. You could tweet that, right? Like it's not particularly profound, but true nonetheless. And the theory of deciding that I'm going to sort of join in to fight for the slice and fight for a little piece of the slice versus fighting for a gigantic pie where there's a ton of opportunity for capital to be awarded much larger than the slice, than any slice, no matter how that slice happens to be defined. Makes it infinitely more difficult, in my estimation, to seek and successfully find that capital. And part of my real interest in being here is changing the way that capital is awarded in the pie. Not the size of the slice, not the existence of the slice, I'm happy for there to be a slice. I want that too. But what I really want is that the pie, the ingredients in that pie, the way that pie gets made, the way that the upstream feeds the downstream problems of who gets a chance to build businesses, who gets to make a decision about where to allocate capital, about the demands of the limited partners in that capital stack. Those are the things that will make it possible for us to participate in the pie, not to have a slightly larger slice allocated to,
That's beautifully said.
all of diversity and all women, which is just crazy.
Thank you, Marla. I appreciate that. Monica, what does that mean to you when you said you're often put in the diversity bucket?
You know, I find it as a big paradigm and a big dichotomy, because on the one side, there's this notion of, you know, the minorities or women being on the sidelines, having like a little program to satisfy a little need. But the reality is that there is a tsunami in the economy that points to the fact that minority communities, and very especially communities like the Hispanic community, are actually probably the biggest force of economic creation, of economic value, of economic development in this country. And so it's this big dichotomy. I always feel like we're riding in a tsunami, but we're one of the few seeing the tsunami, right? And so when I think about the value creation opportunity, like think about the 28 largest corporations in America in last year bought $84 billion from diverse businesses. So this isn't a little pie. This is a very significant pie of the economy. Now, they all want to grow that supply, diverse suppliers, by 20, 30, 50%. So this is a significant economic opportunity in our country that we take incredibly seriously, that our institutional investors take incredibly seriously, and we're just in that rhythm of aligning the right entrepreneurs with the right enterprises, with the corporations and their supplier chains, so that we can achieve a tremendous value creation. So it's this paradigm of feeling on the one side like this, like disadvantaged programs that I hate the name. When I remember I was providing services to U.S. Treasury, said, "Are you part of the disadvantaged program?" I said, "No, God forbid, I don't want to be there," right?
Exactly.
And so this is mainstream. It's just that some of us are seeing it earlier than others.
This is mainstream, great. You, Lily, what's your thought about that? Do you face that issue of the diversity bucket?
Yeah, I mean, I think all the time when people think of Capitol Capital, they're like, oh, Capitol Capital, they invest in Black people. Like, and yes, we do. And I think that that is just a small portion of what we do. And because our portfolio doesn't look like a J. Crew catalog, and we look more like, you know, United Colors of Benetton, which everyone should, then I think the diversity becomes the thing that folks focus on, and they lose the impacts that our companies are having in the world. And I think they lose the fact that we are actually tapping markets, and we're tapping trends and trendsetters. I mean, if you look at underrepresented folks who are traditionally underrepresented in tech, those are the folks who are trendsetters. Who are the main consumers and trendsetters on social media? Like, those are people of color. You know, minorities are not minorities anymore. Like, you know, Latinx population in California, they've now officially become the majority. So it's really that we see that opportunity, and we see the gap in terms of who's had access to tech, and we see that as a means for economic growth and economic creation.
Can I make a quick comment
Please.
on the, like, because there's the contrast. I was thinking about
Monica,
4.6 million Hispanic business owners, yet only 3% have more than 1 million in revenue. So we are in presence of significant disparities, but I think at the top of the pyramid, there's very important mechanisms that are changing and can have the ability to change our community, but certainly big disparities continue to exist.
So each of you has been on the cusp of some really breakthrough work around this question of what does that really look like to create new products and to address this question of having diversity work or inclusion work mainstreamed. What are you most excited about right now? So what's one thing Marla, there's a lot you've done, creating the FS card, which is really about income smoothing for low-income people. Each of you have done remarkable things already. What are you most excited about right now?
So I guess I'm really enthusiastic about the possibility that this conversation, that some of the conversations that preceded this one turns into a movement, right? That there is real change, that there is, in the same way that it took repeated conversation, repeated engagement, repeated, unfortunately, natural disasters, right, for people to engage on the environment and really make that a part of a very large conversation nationwide. I'm hopeful that this turns into a conversation as well, and that we take this from here and leave this room and leave this facility and go out and get others engaged in this conversation and really make some foundational change in what we see. I'm especially excited to hear people talking about the importance of place, and we just had an entire panel about it. I thought Stephen's remarks about the East Side as a paradigm was phenomenal, and I think that tactical description to illustrate the principle is something that very much resonates for me, and that people are starting to recognize some of the challenges around things like gentrification, where the people that have been in place for long periods of time, in some cases generations, not getting to participate in the economic growth and the economic revitalization of their neighborhoods, and starting to see how problematic that is. I'm really encouraged by that. I'll use one quick example here in DC. So for folks from DC, you might recognize this. There's an area in DC where there was a cell phone store that used to blast this music called go-go music. So if you're not from DC, you might not know about go-go music, but it's a thing, look it up.
It's a big deal in this town.
It's a big deal in this town, exactly. And as that neighborhood, that neighborhood has been in a condition that required some investment, I'd say, safely, for probably 30 years, maybe 40 or 50, depending on when you start the clock. Now that neighborhood has started to improve and white people have started to move in, there was a movement to make them turn off this music. That is not inclusion. If you have to change how you live, how you've been living in the place where you have lived, potentially for generations, that is a problem. And the nice thing I saw, the thing that gave me hope, is that it did not work. So the community rallied around it. They brought in lots of, I believe even the mayor got involved. I can't remember, but it became a really interesting sort of nexus here in DC about how are we going to live together, right? How can we get communities to grow and change and embrace difference and allow space for that at the table? Seeing that, seeing the conversation, seeing the struggle come out the way that it did, gives me a little bit of hope, and that's an illustration of the bigger principle about that conversation is actually changing a little bit on the margin.
So that music's still playing.
What's the street
address?
Love it or not, it's still playing.
Do you know the streets? We're going to tell people in case they want to get
Florida
out of the rarefied Willard.
Florida and 7th, something like that?
7th, right. Just
Yeah,
saying,
somewhere around that.
there's
Yeah.
music out there beyond the Willard. Okay. Lily, let me just ask you, what are you most excited about right now that's addressing this question of mainstreaming inclusion in a real way?
Yeah, so I would say two things if I can have two. We at Capitalic Capital, we just released our impact report. We released it last year, which basically all of our haters who told us like you can't do impact and make money when we made that switch, because we started off as a traditional firm, then we switched to impact in 2011. That report basically proved everyone wrong who has told us that for years. And you should look it up, www.capitalicapital.com, impact report. And just really, seeing the tie between the difference that our companies have made in the world and also their financial progress. The other thing is really seeing our founders commitment, which is an initiative that was created by the founders of our portfolio company to help build more diverse teams. And so seeing the success of that initiative, where we have worked alongside our portfolio and their staff to help build more inclusive ecosystems, and did everything from helping them hire to helping them onboard, and how do you maintain your workforce and make sure that they're happy, and really starting to see their numbers shift in terms of like you had environments before where startups had no one who was underrepresented typically on their team, and now they're going, and if you look at the change that they've made and the business opportunities that they've had and business opportunities that they've gained access to as a result of that. Like for instance, one of our healthcare companies said, we initially lost a $10 million contract because we had no one on our team who spoke Spanish. And so now, they actually were able to go back and bid for the contracts, got that contract along with other ones because of the diversity of their team. So really seeing that financial difference that inclusion makes kind of helps us feel like, yeah, we were right all along, and now it's being realized.
That's great. No, thank you for that. Monica, what about you? What are you most excited about in this?
So we currently run a fund of 147 million where we invest in small businesses, right, of $1 million plus EBITDA. And I think that what excites me the most is repeating what is repeatable from the winning stories we've had. How do we create an efficient ecosystem of entrepreneurs, giving them the right resources, not only capital, but shepherding, right, in the different areas where they might need support, whether it's people or marketing or access to corporate America, and creating an ecosystem that is efficient as it's been, for example, in the middle market. But so we're bringing efficiencies that haven't existed in our communities, in our types of businesses, and creating an ecosystem of value creation that is just a more repeatable process. And I'm very excited about that. We created, with the $1 Billion Roundtable, an initiative called the Triad Initiative, where we're actually aligning corporate supplier diversity needs. What goods and services do they need today, and very especially tomorrow? What type of minority and diverse entrepreneurs can provide those services? And then what is the right capital, funds like ours that are enabling and putting together these pieces so that there could be significant growth in diverse businesses. So I'm very excited about how that began being more of a Michelangelo type of work with each one of them that took a lot of time, then can be turned into a more systematic approach, bringing executive operating partners, bringing corporations to the table in a more systematic way. And I'm very excited about that future.
That's great. So we started the day, remember this morning, Wes Moore started by talking about the disconnect, and the disconnect between this idea that the economy was so strong and the reality for so many people. And I want to ask each of you the emperor has no clothes questions. Like, what is the thing we're not saying as we're sitting in this room talking about inclusion and impact? And what's the bravest kind of vision you have or call to action that you would like to share with us? Marla?
So the thing that feels the most urgent for me is the real challenge, and I think there's starting to be some funds that are addressing this. There's a real challenge about the day zero capital being available to entrepreneurs, especially to entrepreneurs of color, where that money typically comes from friends, family, close associated people who are willing to take the risk when there is no business, when it's just an idea and a smile and a PowerPoint deck if you're lucky. And again, sticking with this principle of using some practical example or some real world thing that happened to illustrate this, I was reading a profile of a very prominent person in the business world, who I won't name this person, but although I could. And it was all about how this person built a gigantic real estate business. And I was really interested in this because at times I've dabbled in real estate, et cetera. And I got to the part of the article where the company got into trouble, and then the article went on to say he recapitalized the company by his billionaire uncle. And then I closed this magazine and went off and did something else. Because this article could have been encapsulated with one thing. The way to build a successful real estate business is to have a billionaire uncle, right? And so for those of us that do not have billionaire uncles or anything close to that, how are we going to be able to take these kinds of risks? How are we going to be able to get off the ground to be able to take that very, very first risk position? And the racial lens associated with that is a powerfully important component of it. It's hard for everyone. It is harder for looking at it through a racial lens. And that is a truth that I really want to hear, right? And I want to hear us figuring out ways to address it. I'm encouraged, again, because I do know of a fund. There's an organization in Oakland. There's a lot going on where people are starting to talk about runways and that startup capital, and large organizations, Prudential included, working on trying to be creative about getting capital into funds that are willing to take that day zero risk on entrepreneurs of color. But that has been a massive gap, and it has contributed massively to the racial wealth gap. It has created its massive difference in terms of opportunity. That is, to me, the most important thing for us to really work on.
I love that. Call to action, day zero funding. Monica, how would you respond?
Well, I've lived in two worlds, the institutional world and then working very closely with the corporate world, trying to understand what their supplier needs are. And I love that I'm seeing a connectivity, and it's the ESG connectivity when public pension funds and large institutions are saying to corporations, we want you to be, conscious of your environment, conscious of your communities. And so there's all these concepts on corporate responsibility that are now touching on supplier diversity. And so I would love institutional investors to continue to have these questions and add to the corporations the question, tell me what you're doing on supplier diversity and tell me how you're really scaling and accelerating growth on a few of your companies. Because I think that when the CEO gets that question and he delegates that to his team, it gets done. It gets beautifully resolved. And so I think that elevating the conversation is always just going to yield better and better results. And I would say on the side of corporations, I always invite them to put 5 things on the burner, put 5 possible strategic outcomes. And we have a model that we share that is the SCD model, where we say, think about companies that you have today that you can scale. That's the S. Think about companies that are not diverse, but are going to be changing ownership, and that could, with minority capital and diverse entrepreneurs, turn into diverse enterprises. And those are intersections that happen every day in the market, where if we're on the know, then we can put together a $50, $100, $300 million capital raise and put the operating team to be able to convert into minorities. And then corporate America's every day shedding assets. All of a sudden it's not strategic, or they're in a merger, they need to sell some assets. All of those are phenomenal opportunities to team up with the right capital structure and the right operating teams and generate diverse enterprises. So we're always inviting corporations, put 5 things on the burner. And we're in a business where we look at 100 things, we zoom in 10, and we do 1. So there needs to be many things on the burner so that we really get to, make this a tsunami.
That's great.
Can I just add one thing to that? I just want to channel. There's a gentleman affiliated with the Aspen Institute. His name is Skip Battle, and so some people in the room will know Skip. One of the nuggets of takeaways that I got from Skip echoes, I think, exactly what you just said, which is you get what you inspect, not what you expect. And if we have CEOs believing that there will be an inspection of their suppliers and how diverse they are, their behavior will absolutely change. Right? So.
That's great. That's great context.
Key resources of the organization
Absolutely.
are devoted to that, and
Yeah.
that happens. Right?
No, absolutely. You, Lily, what about you? What's your brave call to action?
Yeah, I think something with the coronavirus outbreak reminded me of in Anand Gehirda's book, Winners Take All. He says we're only as strong as the least empowered people in our community. And so if you think about the workers who don't have enough money to go to the hospital, and those are the people who you're interacting with on a day-to-day basis. And we can't continue to create a society or create companies where those workers are not empowered to take care of themselves, because that not only is bad for them, it's bad for all of us. And so really creating and empowering founders to build companies where they can pay their workers a living wage, and where they can not only hire people from diverse communities, but really empower them and create environments that are equitable for everyone and inclusive for everyone. And that's something for us at KPOR that we're really focused on now, is going into those communities. Like, we're really big in Oakland community, and making sure that those folks who have been in Oakland for years gain access to these high-paying jobs and are not brought on as contractors, but really creating an inclusive economy so that we all benefit, and that tech doesn't just benefit like a small portion of the world.
No, that's awesome. You all are incredible. You're really on the front lines of making this question of inclusion real. So we are almost out of time, but I really just want to make sure that we recognize this team of super women up here. And so does anybody want to see the superpower pose again? Superwoman pose again? Well, before we stop. There we go.
And I think I really want to thank you all for this. And then if everyone just wants to stand up, oh, here we go. Stand up for a minute to take your own superpower pose before we hand it back to our superpower, Ida. If everyone wants to stand up to take a little bit of a break, it's been a long day. Thank you. Awesome. Thanks. You guys are amazing. No questions? No questions.
All right, you guys, we are wrapping up. We are super fast, going off the ring, and I'm just going to hand this over to Omid to say some final words. But before I do that, I think one reason I'm taking more of your time at the end of the day is because there's some thank yous that really need everybody to join me in them. I want to thank the team that put together today, Libby Franklin, Azalea Milan, Katie Drasser, Francine Chu, really, core team. That's a blended team of Aspen and Prudential, and it's been a blended process from the beginning. I also want to thank all the volunteers, and I want to thank the staff here at the Willard who have been incredible. And then I want to stop thanking people and tell you that there's more to come. This is trying to build a movement. There is more to say. We'll just say it later. So Omid, please come on up. Thank you so much.
All right. Well, so I think, at many moments in my life, people have said I have the best job in the world, getting to run the Prudential Impact Investing portfolio. I now think I have the worst job, getting to close out a day-long conference as sort of complicated and sort of thought-provoking and ultimately challenging as today. I don't think anyone could really do today justice. I think, as we look back on our portfolio, we couldn't really do it justice, right? $1 billion over 8 years is an enormous sum of money invested with everyone in this room. But I think what we wanted to try to at least show today a little bit was that ultimately we think all of this complexity is part of why we're here, that the work we've done on all of these different issues, place-based development, racial equity, systems change for capitalism. If you look at our portfolio, we've got examples of all of that. And we've actually invested against it, right? We haven't just thought about it, talked about it, treated this as an academic issue. When we talk about having actually put this money out the door, and to be clear, it's not just that we've put $1 billion, the portfolio is a living, breathing, billion-dollar entity that's performing extremely well. So the equity investments have double-digit returns. But that isn't, I think, the measure of success. The measure of success ultimately is whether we're really moving the needle on pushing forward. The thing that makes me so happy as I sit out here and look at everyone and such close friends is that all of you are living, breathing, ongoing concerns, right? That even some of our investments that haven't worked, every one of those people is back on their feet in some equally compelling capacity. And that really matters, right? And that's kind of the point, because I think actually, you can't do this work and do this work really well without taking risk. There's tremendous risk involved in the investments we do, but the question is, have we gotten a return for it? And I think it's clear we've gotten it financially, but I think the social impact is just begun, right? Everyone in this room, I expect, will be 10 times bigger in 7 years. Will be 10 times more important. And that arc, right? Somebody talked about, I think Stephen talked a little bit about sort of the compounding effect of social change, right? So it isn't just what we've done today, it's the compounding effect of those changes. And it's also ultimately the sort of compounding effect of those changes on changing how people make decisions. One of the things that I find very sobering, and I sort of want to mention because I think it's a bit sobering, is that we funded this research with Jennifer Eberhardt on how people approach fund managers. And what was so striking about this was that actually what her research found was that capital allocators were obviously, as we'd expect, systematically less likely to allocate to diverse teams. We kind of knew that was going to happen. But what we were shocked to find was that actually that bias got worse the stronger the track record of the team. Right? That actually the more they performed, that simply proof points wasn't enough. It reminded me actually of sort of Michelle Obama's speech a few years ago, that we don't just have to be equally good or as good, but we have to be twice as good. And I guess that's sort of my call to action for this room, is that everyone in here is a living, breathing proof point to the reality of this being able to happen. But to go farther, the problems are 4 times as hard as we think, and we need to be twice as good to solve them. And that's sort of, I hope, sort of the message we take forward, is that we can do this, and we can do this together. Because ultimately, I think what struck me over the years as to sort of why we've been able to do this, right? Why have we been able to go after complex, intractable issues and somehow do it, right? Actually do it. There's a couple of things that have really struck me. One, the people in this room, right? There is something fundamentally compelling. You can see the bios. Charlie talked a little bit about it. And all of my interactions with you, I am constantly blown away by just how smart, how talented, and ultimately how mentally deranged you all are. Most people, to Stephen's example, don't run towards fire, right? But everyone in this room runs towards fire, right? They see these problems, these biases, race, poverty, distressed communities, emerging markets, right? Every one of these, there'd be an easier way to make money, right? And yet, all of you have intentionally chosen to give up the easy way and to go the hard way. And what that's created actually is an incredible culture, right? It's a culture that I think is mutually reinforcing. I look at this room and individual investments have helped each other. And that sort of value add component, right? We can do hard things, but doing them together. And actually sort of what I've seen over time is that taking this sort of multi-sectoral approach means that insights from one place show up somewhere else. So we have people here who've been at the forefront of working on bottom of the pyramid issues in Ghana, and people who've been working in Newark. And on the surface, that doesn't necessarily seem like there'd be a lot of congruence, but time and time again, the insights from one place show up somewhere else, and ultimately show up back in our businesses. And so I think it's that sort of virtuous arc, that knowledge transfer, that gain, that sort of, I think, inspires me, because I think these problems are hard, and they are complex, and they are multi-sectoral, and they do require all of us, I think, to think differently, behave differently, and show up differently. And what's been great about doing that, though, is that it has been a fundamentally collaborative ecosystem. Everyone in this room, I can see, has helped me and helped each other in ways that are incredibly profound. And that's not the norm in the business world, and I think it's a real testament to everyone here. So I couldn't be happier to be celebrating this with everyone. I'm so proud. I want to thank the people who put this together. I think Francine actually had to go run to the museum, but she was sort of done an amazing job pulling this together. Sarah helped inspire us to do this. I'd love for my team actually to stand up, because for all of you who know, or actually probably don't know me, because they're the ones who do all the work. And while we're at it, since look, this has been something we've all done together, I'd love for all the people we've invested in who are still here, I'm sure they're all out in the hallway doing deals, but if any of you have sort of been investees or grantees of the Prudential Foundation, we'd love to sort of give you a round of applause as well. And then finally, we just want to thank the colleagues at Aspen who helped us put this together. This has been a great day. We had to, surprisingly, since we're an hour late, we did have to cut some stuff. But if you see on social, we actually have an incredible video we just put out sort of on Twitter about sort of some of the work we've been doing in emerging markets. And I think there'll be other stuff sort of going on in the ecosphere, so you don't have to stay here for another 6 hours. But with that, please enjoy a few minutes off and join us at the Smithsonian Museum shortly. We'll be starting the party at 6:30, and I promise there'll be great drinks and great food. And more than anything, I really do want people to have the opportunity to meet each other, because I think the reason we organized this ultimately was to sort of give opportunities for really radically diverse strands of thought, ways of thinking, ways of showing up to hopefully interact in ways that are powerful for the future. So thank you.